Hey guys, we'll wait for another 5 minutes just for everyone to join in. Guys, we'll start in next 5 minutes.
Sir,
Yes,
I have a doubt regarding the regulation impact and the environmental impact.
yes, please tell me.
So if there is a regulation regarding environment and the company is in complying with it, will it come under regulatory environment or regulatory impact or the environmental impact?
Which one?
So, for example, if there is a regulation regarding environment and the company is in complying with it, under which header will it come, sir? The regulation
Okay,
or the environment?
see, I'll tell you two things over here, okay?
Okay.
Regulatory impact is something which by the regulatory authorities is put in place. Okay. Like for example, if you look in India, uh, you have TRAI, you have RBI, you have Airport Authority of India, you have Silk Board of India, you have Coffee Board of India. If these guys set some rules, okay, that's a regulatory impact. Okay. Apart from that, in India, environmental rules and regulations are set up by the environmental bodies. Okay. It could be it's a government driven regulations. Environmental impact, what typically happens is it applies to all the industries in general. Like for example, your CSR activity. Any company who's making profit in India, there's a certain set of calculation that needs to be done as per Companies Act. They need to, uh, if they are making profit, they need to donate an X amount of profit towards CSR activity. Now, see, understand. This is something that is set up by the regulatory. This is not something that is set up by the regulatory bodies. This is something set up by the environmental committee specifically. Okay. Any rule set up by the regulatory authorities is a regulatory impact. Apart from that, it will fall under environmental impact. Typically, what happens is all your regulators and everyone, they primarily focus on ensuring that the consumer interest is protected. They will not have rules with respect to the environmental issues. Got it?
Okay, sir. So the regulatory bodies is focused on protecting the interest of the consumers, so they do
Correct,
not
correct, correct. Like your SEBI, right? SEBI doesn't say
Yes.
what CSR activity or what other kind of activities you need to do, right? SEBI ensures that the investor's interest is protected, correct?
I see. So if there is any rules regarding the environmental, it will come under environmental impact.
Correct, correct. Because the environmental is something which is specific, okay? And that would apply to all the industries or anyone that is working in that field.
Okay. Fine.
Understood?
Yes, sir.
Okay. I'll just wait for the last 2 minutes and then we can start. I hope everyone can see my screen.
Yes, sir.
Guys, is everyone able to see my screen?
Yes, sir.
Yes, sir.
Okay. Guys, let's start. Today we will be learning about basics of investment appraisal. Okay. Now, many of you might think that this is something which you have already done it or already done it in your past studies or something and all. But trust me, this basic, okay, getting your heads clear on this basic concept is something that's gonna help you in AFM. Okay. I'll tell you any questions in AFM or any of the topics that we do. If you just know the basics, you'll be easily able to pass the question. Plus, along with the basics, if you know a little bit of advance, you'll be able to score good. Okay. So we need to be clear on this basic parts around. Have you guys heard of the term free cash flows before?
No, sir.
No, sir.
No
No, sir.
one.
We heard cash flows, but not free
Yeah,
cash
free
flow.
cash.
What do you mean by cash flows?
Inflow, outflow, cash
Inflow,
inflow.
outflow. And does anyone know how do you prepare a cash flow statement?
Yes, sir.
Can you tell me?
Starting from operating activities,
Operating activities, correct. Then
financing activities,
financing activities,
and
then
investing activities.
investing activities. Okay. Now, I'll tell you one thing. Uh, in today's world, okay, you have seen a lot of startups that are making losses, right? All the startups and all in the initial phases in their life, they are making losses, correct?
Yes, sir.
Right? Now, but still people are valuing them at an X amount, correct?
Yes, sir.
What do you think? How are they deriving their values?
Growth potential of the products served by the company.
Correct. But we all know with the level of growth that they are getting, the level of losses are also going up.
Based on their investment,
Sorry,
based on their investments,
based on their investments. No. A loss-making company, how will they have an investment? I understand if you make a profit, you do investing activities and everything. But if startups are a loss-making activity, they don't even have enough profits to make an investment. How will they do it?
maybe they have a, unique product, unique service.
Okay.
They could be a market leader.
Okay. Market leader would be a non-financial factor, something that you are speaking on. Okay. Let's understand the financial aspect. Uh, Everyone knows what do you mean by a gross margin?
Yes, sir.
What is gross margin? Can you tell me the formula for gross margin?
Gross profit divided by sales revenue.
No, that's the calculating the percentage of gross margin. How do you calculate a gross margin?
Manage the cost of goods.
Sorry,
Sales minus cost of sales.
sales minus cost of sales. Now tell me cost of sales is a variable cost or a fixed cost? Variable cost.
Variable.
It's a variable cost. Okay. Why do you think the gross profit matrix is very important for you? Any guess?
And it tells us the
profit arising from the operation of the business.
Okay, correct. Now you guys have answered already the factors and all, okay. Now let's understand how these dots connect, okay. You have your gross profit, you have your overheads, and then comes your net profit in the P&L, correct? Okay. Any investor is always interested in your EBITDA. Do you guys know full form of EBITDA?
Earnings before interest, tax, depreciation, and amortization.
Earnings before interest, tax,
Tax, depreciation,
depreciation, and
and
amortization.
amortization.
Okay. That means EBITDA is nothing but purely talking what is your operating activities, correct? Now understand, if your operating activities, okay, is on a growing trend, okay, first year you had 100, then you had 200, then you had 300, then you had 400, okay, your variable cost will go up and your gross profit will go up, okay, but year on year, will your fixed cost go up?
No.
No. Why? Because it is a fixed cost,
Fixed.
right? Now, the reason a gross profit matrix is so important is because year on year, when your gross profit grows, after a point in time in life, okay, of the project or of the company, the gross profit will grow to such an extent, because see, any startup, okay, any startup in the world will always ensure that their gross profit is positive. Okay, that means their operating activity is profitable. If any company's operating profit is not there, then typically that startup is not worthwhile investing. Anyone who's doing any sort of investments, or any investors or angel investors, they will always ensure that their gross profit is positive. Why? Because sales minus variable cost. If you don't have a margin over there, then you are doing a loss-making business. Correct. Now, startups are making loss because of their fixed cost. Correct. Like your rents, your salaries, the head office guy salaries, your leasing expense, and everything. Okay. Now, typically what happens is, after a point in time, if your gross profit keeps on growing, there will be a point in life where your gross profit will reach to such an extent that it will be equal to your, it will cover your overhead expense also. That is your fixed cost. Correct? Because gross profit will grow, but the overhead expenses will not go. That is nothing but my fixed cost. Correct? That's why we call them a fixed cost, right? So your fixed cost after a point in life will grow to such your gross profit will grow to such an extent that it will cover your expense for your fixed cost. Okay. And after that point in time in life, that means these company will break even. And because the gross profit year on year has to grow. Because if revenue grows, automatically your gross profit grows, because sales minus variable cost is your gross profit. Understood? This is something you guys must have learned in costing.
Yeah.
Right? You guys must have learned in costing that people are majorly focusing on gross margin. They don't care what's your EBITDA. They don't care what's your net profit. They don't care all these numbers. Okay, because if you want to assess someone on their future potential, you will not look at what they're making today. You look at how far they can go in future. That's how these startups are being valued. Amazon almost took 22 years to break even. Okay. People are investing in these companies because their revenue was growing. We all know if the revenue grows, the gross margin grows. If gross margin grows, after a point in life, there will be a point where your gross margin will reach to such an extent that it will cover all your fixed costs. Okay. This is on the costing front. Now let's understand how is this relevant to free cash flows. Okay. Free cash flows is nothing but kind of cash flows. Okay. Now, free cash flows is nothing but, if I would say, if I have to do a calculation or any of such thing, I would say free cash flows is nothing but my EBITDA. Okay. We all know accounting standards. Okay. Do you know what do you mean by an accounting standard? What is it? What do you mean by an accounting standard?
There are a basic set of rules that you have to follow while making accounts.
Correct. Accounting standards are subject to interpretation,
Yes.
right? Because you understand, accounting standard is not a rule, it's a law. Correct. There's a difference between a rule and the law. Rule says do X, you need to do X. Law says this is what I'm expecting. Correct. I'm expecting this. How you do it? How do you assume what is the expectation is up to you. You need to be convincing. Correct. That's how lawyers deal in the courts and all, right? They twist the law because law is subject to interpretation. Similarly, profits that are there, the net profits and all, are subject to manipulation. Why? Because you can interpret the law. Correct? You can interpret the accounting standards, you can interpret these things and all. Clear? Any questions till now? Okay. Now, free cash flows means, see, because when we are dealing in AFM, we are looking at whether the investment is beneficial for me or no. I'm not here to see whether I'm making profits or not making profits. I'm here to see whether I'm making cash or not making cash. Correct. If I've given you 100 rupees, I want 120 in cash. I don't care what your company profits are. Correct. Because in terms of profit, you have a lot of adjustments. You have carry forward balance, you have amortization, you have depreciation, and all of those things. See, these are non-cash items. Correct. Non-cash items, end of the day, it's just there to ensure that you're making net profit or not making a profit. But free cash flows will tell you that at the end of the assignment, whether you're making cash or not making cash. Clear? Clear, everyone? So, any calculation that we'll be doing in AFM will only be there if it's a cash element. If there's an income of real cash, we will factor in our calculation. If there's an outflow of real cash, we'll factor in that calculation. Okay. We will not be considering any of the non-cash items. That means your depreciation, your amortization and all. Okay. Interest element, I will explain it to you separately, why we don't consider. Okay, when we go forward in the syllabus and all, there's something called a discount factor. Over there, we'll discuss why interest is not considered. Okay. Now, free cash flows is nothing but something after revenue minus cost minus investment. Okay. We all know when like we saw in our last class, right? We are the ones who decide what is the level of investments we need to make, what is the level of dividends we need to distribute. Correct? Yes or no, everyone?
Yes, sir.
We decide what is the dividend we need to make.
Yes.
Now, why do we decide? Because we know what is the cash element of revenue, what is the cash element of cost. After that, we want the company to grow. Correct? If we want the company to grow, we need to ensure we make periodic investments. Correct? If we want the company to grow, we need to ensure that we make periodic investments. Correct?
Yeah.
When we are making periodic investments and all, after that, we see what is the cash balance left with us. Okay. We will have some emergency, we'll have everything. And after that, so after meeting all your cash expenses and cash investments, whatever is left with you is something which is known as free cash flows. That means you can spend that money without hesitation. Clear? Clear, everyone?
Yes.
Yes.
Okay. Now, free cash flows are used for your investment evaluation, assessing company's net worth, assessing what is the valuation of the company when you're doing for a mergers and acquisitions. You can use it for your policy formulation. Correct? Why do you think we are using free cash flows to decide what is the level of dividends I need to pay and not the net profit? Why do we use the free cash flow as a matrix to decide how much dividend to pay rather than going for net profit? Anyone?
It provides the actual the
Sorry?
profit can be manipulated, but the cash flow cannot.
Now let me give you an example of this, okay? You made a profit of 100. Okay. But does that mean that you have 100 rupees of cash with you?
No, sir.
No,
No,
right?
sir.
Cash could be higher or cash could be lower. Correct?
Yes, sir.
Yes.
Right? But when I decide to pay dividend, I cannot take 100 rupees as a matrix, because if I decide 100 rupees I need to pay as dividend, and if I do not have enough cash balance with me, I will not be able to pay the dividends. Correct? Even though I made a profit. Because see, profit, what happens is you have carry forward losses, correct? Which you set off and all. Then you have depreciation, you have amortization, you have some non-cash positive items like your revaluation. Have you heard the guys concept of revaluation?
Yes.
Can someone explain it to me? What do you mean by revaluation?
Increasing the
Revalue.
value of
If an asset is costing 100 rupees, and if the market value of the asset is today 150 rupees, that means 50 rupees is a gain for you. Correct? But does that mean you are getting that 50 rupees of real cash?
Unrealized gain.
It's an unrealized gain. Correct?
Yes.
Right? Why? Because that cash will come to you only after you sell that asset. If you don't sell that asset, that money is not coming to you. Okay. So unrealized cash increases your profit, the final net profit I'm talking about. Okay. But it will not increase your bank balance. And if you decide to give that 50 rupees also away, you actually realize you don't have that money in the bank. Correct? Because when I'm committing to investors, I'll give you dividends. Where will I give it from? So this is why we use the free cash flow element as a matrix to decide how much of the dividend is to be paid. Clear?
Yes, sir.
Okay. Now, while calculating free cash flows, we only use relevant cash flows. Have you guys heard of relevant costing?
Yes, sir.
Yeah. Only one person. Anyone else who knows about relevant costing? Anyone else?
yes, sir.
Okay. Can you tell me what do you mean by relevant costing?
Future incremental cash flows or relevant cash flows, like opportunity cost and incremental cost.
Okay. Now let me give you an example. There's a Nike factory. Okay. They are planning to manufacture socks now. Okay. They already have an existing factory. They have some space available there with them. And they're planning to set up their socks machines over there. Is rent a relevant cost for the socks business or an irrelevant cost?
Irrelevant.
Sorry?
Irrelevant.
Irrelevant or relevant?
Relevant.
Relevant. Okay.
Oh, wait.
Let's say they are buying a new space to set up the machinery. So is the new space rent relevant cost or an irrelevant cost?
Relevant.
Relevant cost. Okay. Now guys, listen to me carefully. Okay. In the first instance, when I said to you, they have an ideal space. Okay. They're setting up their socks business over there. That time rent is an irrelevant cost. Why irrelevant cost? Because you understand, whether you put up a socks machine or you don't put up a socks machine, you're still paying a rent.
Yes, sir.
right? You're still paying the rent, right? Because your shoes business is going on, right? You're
Yes,
still
sir.
paying the. You start the business or you don't start the business, the money is still going. That means that is an irrelevant cost for the socks business because you're getting and using an ideal space for yourself. Clear? Okay. Relevant cost is something which might affect your investment decision. Like, should I buy an extra space? That time my rental cost will go up. Yes, it becomes relevant. But if I have an existing space, I can utilize it to increase my profitability because irrespective, I'm paying a rent. Correct. Whether I start a business or I don't start a business, the rent is still getting paid, right? Yes or no, guys?
Yes.
Yes, sir.
Right. Whether you do something or whether you don't. So understand, if something is available to you and you are not having an incremental cost, it is an irrelevant cost to you. Clear? Now, when we do investment appraisals, we will only use relevant costs, relevant cash flows. That means something which is occurring only if I have to start that particular business or only if I do that investment. Clear? Clear, everyone? Okay. Now, whenever you are doing investment appraisal, there are a lot of methods. There are lot of methods that you do for investment appraisal. Like, for example, your NPV, your IRR, your MIRR, your discounted payback, your Macaulay duration. Okay. Now, these all are nothing but an indication matrix. Okay. Why do I call them an indication matrix is because these indicators tell you whether you should go with that investment or not go with that investment. Clear? This typically tells you, should you go do that investment or should you not do that investment? Clear, everyone?
Yes, sir.
Okay. We'll go one by one in detail. Okay. Have you guys heard of net present value?
Yes, sir.
Yes, sir.
Okay. What do you mean by net present value?
Net present value of all the cash inflows and outflows.
Sorry.
Present value of all the cash inflow and outflow together make it a net present value.
Present value of the future cash flows.
Okay. It is nothing but the present value of all the future cash flows. What do we mean by present value? We'll discuss that in detail. Okay. But what net present value tells us is that if you are making an investment of 100 rupees today, what is the cash returns? Okay. Understand, I'm not talking about the profits. I'm talking what is the cash returns that you make over the life of the project. Okay. That means in the next 5-6 years, if the project is going on over the life of the project, what is the level of returns that you're going to make? Okay. Now, everyone has had Coke or Cadbury in past, if you remember. Do you know what is the price of a bottle of a glass bottle of a Coke and a price of a normal Cadbury in the past? How much was it? The price of a bottle of a Coke, what was it? Do you know in the past? You know,
10.
earlier we used to get Cadbury and everything for 10 rupees, correct?
Yes, sir.
You remember we used to get a good amount of chocolate for 10 rupees. Are we still getting at 10 rupees today?
No.
Yes. Yes.
Okay,
Yes, sir.
understand. Okay, I agree to you, we are still getting at 10 rupees. But is the quantity same?
No.
No, sir.
No,
Why?
they have
Shrink
shrink.
shrink inflation.
See, there are two kinds of approaches that company does. Okay. Either they will keep the quantity same but increase the price, or they will keep the price same and reduce the quantity. Correct? Okay. Why do they do that? This is nothing but this is something called inflation, time value of money. Okay. That means 1 rupee today is not equal to 1 rupee 1 year or 2 years down the line. Correct?
Yes, sir.
Yes or no?
Yes, sir.
1 rupee today is not equal to 1 rupees or 10 rupees down the line. Correct? That is something we call as time value of money. It's not that the value of 10 rupees is not 10 rupees. Okay. The note, everything holds the value of 10 rupees, but you don't get the same product with the same quantity for the same price 10 years down the line because of the inflation. Okay. Or I would, in my terms, I would say that is something which is opportunity cost. Correct? If you have 10 rupees today, you can invest that money in FD and you can start making returns. Correct? Yes or no?
Yes.
You can start making returns. Correct? That means something which you are losing on the opportunity cost is we call it as a time value of money. Clear, everyone?
Mm.
Any questions till now?
No, sir.
Okay. Based on the NPV matrix, how do you decide whether you should do an investment or not do an investment? If NPV is positive, you should go ahead with the project. And if the NPV is negative, you should not go ahead with the project. What does NPV tell me? NPV tells me that if I made a 100 rupees investment in the project today, then over the period of the project, I'm making 150 in cash or whether I'm making less than 100 in cash. Correct? Now, tell me one thing. I invest 100 rupees and over the life of the project, I make only 100 rupees. Am I in profit or am I in loss? Or am I at break even?
Break even.
No, I would say I'm at a loss. Can you tell me why am I telling that?
Because of present value of money.
Opportunity cost.
Sorry?
Opportunity cost.
Because of the opportunity cost. Rather than investing in the new business, if I would have invested that 100 rupees in bank account, I would have made 6% returns. Correct? So if you're making 100 rupees today, you need to ensure at least for the break even, you make 110. Make sense? Yes or no?
Yes, sir.
You need to ensure that at least you make 110. Clear? Let's understand what do you mean by relevant cash flow. Okay. I'm sure you guys must have heard this term before, sunk cost.
Yes, sir.
I think only a couple of people understand that, all right? What is sunk cost and all? What about others? Do you guys know what do you mean by sunk cost?
Yes, sir.
Can you explain?
That's the cost which already occurred,
Give me an
and
example of such cost.
like in your first example, the rent
Okay.
for previous.
Rent for ideal space,
Yes, sir.
correct? Is a
Yes,
sunk
sir.
cost. Okay. Now there's a difference between a sunk cost and an relevant cost. Okay. This is what do you mean by sunk? Now, sunk cost is something which whether you do that investment or you don't do that investment, that expense is already happened. Like I said, when you have an idle space, the rent for that idle space is an irrelevant cost, or we can say a sunk cost. Then you have your research and development. When you spend something on research and development, does that necessarily mean that you're gonna do that investment?
No, sir.
Why?
It may be not like,
There could be two reasons. Okay. You developed a product. It is very good for the society. It is very good for the consumers. Okay. But it is not financially feasible. What do you mean by financially feasible? Means that the price of that product, the cost of making that product could be so high that people cannot afford it. Correct? Yes or no? If people cannot afford it, that means you cannot launch that product in the market. Why? Because no one is going to buy it. You have done your research, you have done your development, you have spent so much of money on that. Okay, your product is also excellent. People want to buy it, but the price point is so high of selling that product that people cannot afford it. Okay, so in that case, any research and development you do does not necessarily mean that you're gonna launch that product or you're gonna invest that product. Correct? Yes or no?
Yes, sir.
So that's why we call it as a sunk cost or research and development. Now coming on to the interest cost. Interest cost is something which is already factored in your discount factor. Okay. I will tell you what a discount factor means. That means nothing but considering the inflation and the opportunity cost that you have, what is the inflation and everything that you're gonna do. Yeah. Now, why do you think dividend is an irrelevant cash flow? Dividend is a cash item or a non-cash item?
Non-cash item.
Dividend is a non-cash item.
the
Cash
cash
item.
item. Cash
Fine.
item.
When you pay dividend, does actual balance from your bank account goes up and down?
Yes.
Yeah.
Yes, sir.
So that means it's a cash element. Now, dividend is an income or expense.
Expense. Finance.
Understand this very carefully, okay? Dividend is not an income, not an expense.
It's a distribution of profit.
It's just a distribution of profit. Whatever profit you make, it does not reduce the profit. You're just allocating the profit to your shareholders, correct? So don't get confused with says dividend payment or let's say dividend expense and all of those things. Dividend is literally not an expense like your working capital, correct? Dividend is just allocation of profit to the shareholders. Clear? Now, non-cash items, what do you mean by non-cash items? Non-cash items is where your actual money is not involved. Let's say depreciation. When you put a depreciation expense in P&L, is your actual bank account moving?
No.
Anything which moves your bank account is a cash flow. Anything which does not touch your bank account is not a
Not a
cash flow
cash
for
flow.
you, and you cannot be taking that into your any of your whole of AFM, I will tell you. You take investment appraisal, you take risk management, you take options, you talk about mergers and acquisitions, anywhere in the whole of syllabus. If something is not touching my bank account, I'm not going to deal with it. Okay? Because when you see Shark Tank and all, you'll realize that a lot of investors and all, okay, they are more interested in what is your cash flow cycle. They don't care what is your profit. They don't care how much margin you makes and all, nothing. No. Margin, they will only ask you EBITDA margin. Has all of you seen Shark Tank? I mean, any of the episode, even if you have seen one episode, you guys have seen Shark Tank?
No, sir.
Yes. Yes, sir.
Yes.
Yes.
If you have seen multiple episodes, have you ever seen these guys asking, okay, what is your net profit?
No. Margin.
You must have seen they always talk about margin. इस पे आप कितना पैसा बना लेते हो, right? I think most of the time, Anupam, who's from the India Shark Tank, who's the founder of Shadi.com and all, he has one standard question. आप इस पे कितना पैसे बना लेते हो? That means he's asking इस पे आप कितना margin या कितना EBITDA बनाते हो, correct? If you look at US Shark Tank, they'll say, okay, Kevin will say, okay, what are your margins? What are your gross margins? What is your EBITDA? They will never ever any of the investor ask you what is your profit. Correct? Because everyone knows profit is subject to manipulation. They can play around with the accounting standards and show that their company is profitable. But you cannot manipulate gross margin. Why? Because gross margin is equal to sales minus variable cost. If you don't do a sales, you will not have a variable cost. Even if you sell one product, you are making a margin on that. Correct? That means you are making money operationally. See, any company in the world to be operationally profitable or in the world to grow, they need to ensure that their operating activities cash flow is positive. Okay. Now let me tell you, give you a scenario. There's a company who has a cash flow statement, but their cash flow statement is negative. Is it a good sign or a bad sign? A company is there, it's a loss-making company. Their cash flow is also negative. Is it a good sign or is it a bad sign for the company? When
Bad.
you have to talk
Bad
about
sign.
Bad
Bad.
sign.
Sorry? Good sign or a bad sign?
Bad sign.
Bad sign.
Bad sign. Why do you think it's a bad sign?
Outflows
It
exceed.
affects their cash.
Okay. We all know what does your cash flow statement consist of? What all elements is there in your cash flow statement?
Operating, investing, and financing.
Operating, investing, and financing. Do you know whether their operating is negative, financing is negative, or investing is negative? Let's say company operational would be positive, but since they are growing too much, they are spending too much on their investment activity. What if their cash flow is negative because of investment? Is it a good sign or bad sign?
Good sign.
Because the asset is something which generates revenue for you. To create an asset, you need to make an investment. Correct?
Yes.
If you're making an investment and your cash flow statement is negative, it's a good sign. Today you're negative, but tomorrow as the company grows, as the revenue grows, you may be profitable. Correct?
Yes, sir.
So never judge any of the company's financial performance based on
Net cash.
their cash flows and all. Okay, you have to judge, but you have to analyze. Correct. If you give that cash flow statement to a normal person now, they will say that okay, fine, the company cash flow is negative, it's not doing good. But you guys are accountants, you guys are chartered holders and all, correct? So what is expected from you is to do a detailed analyze to see whether that cash flow is a good sign or a bad sign. You need to tell them whether, okay, guys, company is doing negative, but understand these guys are doing investment, right? Any startup and all, they need funding and all of these things to ensure that the company grows because they need to buy assets, they need to buy everything, right? Yes or no?
Yeah.
Yes, sir.
Right. So a lot of people do this mistake like saying, okay, a company's cash flow is negative, this company is not good. No, but understand, I totally agree to you if the company's operating activity is negative. If the company's operating activity is negative, then company is never making money. Clear?
Hmm.
If the operating activity is negative, because see, that's the only source of inflow for the company, correct? Even if you buy assets, you're buying machineries, you're buying plants, you're buying vehicles and all of those things. End of the day, those investments are going to translate to your operating activity only, right? A company will not do an investment in buying shares and all, right? Shares and investment buying subsidiary, they will do when they actually make net profit, correct? With the investment or getting the finance from the market, they will expand their operational activities, right? So end of the day, if they are doing investment, their operational activity and revenue has to go up. But if the cost of the product is 1 rupee and they are selling it for 50 paisa, there's no chance in the world that these guys are going to turn profitable. Clear? Any questions still here?
No, sir.
Now, guys, this all things I want you to be conceptually clear because when we do NPV questions and all, you'll realize this small things. Okay, which is relevant, which is irrelevant, because see, any guy can calculate an NPV, I'll tell you, or he can calculate a cash flow, but whether it's the right thing to consider in your calculation or not is something technically he may not know. Everyone's okay, paisa aaya, paisa gaya, money coming in, money going out, you're profitable. No, you need to understand, because see, if there's Nike as a company, they just don't track ki, okay, what is their profit, correct? Everyone checks departmental level of profit. Let's say Nike will say, okay, what is the profit I'm making on my sports category? What is the profit I'm making on my slides, or let's say flip-flops and all? What is the profit I'm making on sneakers? Correct? It's a different category, right? They need to ensure that their categories are profitable. If their categories are not profitable, tomorrow they might, then it may be irrelevant to spend money, right? Because what will happen is, say, let's say your sneaker is profitable and sports may you're making loss. What will happen? Sneaker will offset the loss for the sports, correct? But as a financial guy, if you stop the sports business, you may rather have a double cash flow, right? Because you'll not be burning money. Though you might achieve your target. Let's say Nike has a target of 100 rupees to achieve as a revenue. And if Nike has 100 rupees targets to achieve as a revenue, then they are making 200 in sports and 200 in sneakers and 100 rupees loss in sports category. What everyone will say, oh, nice, Nike has achieved the target. Correct. But if you think logically, if Nike wouldn't have done that sport business, then they would have overachieved their target. Correct. Because the sneakers already made 200. Understood?
Yes.
Any questions till here? Any questions?
No, sir.
So, that's why whenever you're doing any kind of analysis or any kind of free cash flows or any kind of investment opportunities or any kind of these sort of things that you're doing, you need to ensure that you go to the detailed breakup. Company, that's why they have a huge finance team. They track each and every category. Like if I say for e-commerce, mein, they would have a electronics head, they would have an beauty head, they would have an apparels head, they would have your home appliances head, because all of these is a category. Correct. If you want to be profitable, each of these categories has to be profitable. One person single cannot look at it. Correct. Now, talking about time value of money. What do you mean by time value of money? I'm very sure you guys must have come across this terminology before as well. What do you mean by time value of money? I just explained a couple of minutes back as well. What do you mean by time value of money?
Converting future cash flows into present value.
Converting
Future cash flows into present value.
future cash flows into present values? No.
So the value of 1 rupee is not equal to value of 1 rupee in the future.
Right. Value of 1 rupee today and value of 1 rupee 10 years down the line is not same. Why? Because of the inflation, money loses its value. That's why we say money sitting in your bank account, idle money. Okay. People say, we still say that we are incurring loss. Correct? Money sitting in your idle bank account, idle, you must have seen, "Arey, paisa bank account mein baitha hua hai," you are incurring a loss. But you don't know why. Account has 100 rupees. Next month also it has 100 rupees. Technically speaking, if I make a loss, the 100 rupees should become 99 rupees. Correct? But think from this standpoint, your bank account still has 100 rupees. But few years back, for 100 rupees, you could buy an iPhone. But now with that 100 rupees, can you buy an iPhone? No. the value has gone up of the phone. So it's an indirect loss to you. Products are getting costly, but your money is not growing. That is, we call it as a time value of money. Okay. Clear, everyone? Anyone has any question, guys? If you guys feel it's going too fast or if you are not getting something, feel free to stop me in between. We can discuss. We are over here to understand and make sure that your concepts are clear. Okay. Because ACCA, there is no way that you can get a repeat question. When I mean a repeat question, that means if you look at typically what happens is you have an exam book, right? In that questions, which question gets tested randomly happens. But ACCA, what happens is they create new questions with the concepts that you are studying. So knowing the concepts is more important to ensure that you apply it correctly. Our objective over here is to make sure that you understand the concept and you apply the concept. I don't want you guys to just read what is there in the books. Okay. You need to be clear because what happens is all of these concepts you will use in real life. I will give you an example, real life example of this, which I myself have worked upon this. There was a company, okay, where we had an assignment for business consultancy. It was one of the listed companies in India as well, where we were not getting any money. We would only get money if we save money for the company. See, business consultancy assignments are not typically, it's more into deciding how much savings you're getting for the company, correct? So our revenue was based on saying that if I save 1 rupee for the company, I would get 15% of that. So if I save 100 rupees, I will get only 15 rupees. But if I say 100 crores, I will get 15 crores. Okay. Do you know what are the two types of savings that you have? Now, when I have to save money for the company, okay. If I go for only 1 year, let's say I figured out 100 rupees is a saving. Any company has an operational optimization limit, correct? What do you mean by operational optimization limit is that the best way in the industry, okay, the most efficient way of working is known as optimization. Once you reach that most efficient way of working and there is no new technology available in the market, can you increase, can you decrease your cost beyond that point? Yes or no?
Yes, sir.
You can. How?
Learning curve.
You have reached the learning curve. That's what I'm saying. You have reached the learning curve. You have reached the most efficient way of working in that field. After that, what? And there is no new technology that has come to help you. After that, there's no new development yet happened. Once you reach that learning curve, can you go beyond that point?
No.
You cannot go beyond that point. Okay. Now tell me, I know that after the learning curve and all everything, I would max reach 1,000 rupees. Okay. That means I will only make 15 rupees on that. Correct? But as a finance guy, if you want to increase your revenue, how will I do it? What do you think I can do here? What are the other options that I have? Can I manipulate my savings? Or can I inflate my savings? Understand, I'm not doing a fraud over here, okay? I'm not doing a fraud over here. And other guy is also not mad, or other guys is not even let's say someone who would just randomly pay you money. What do you think? Come up with some ideas. I want you guys to think over there. If I have reached 100 rupees of savings and I want to further reach an optimization level, how can I get money? Because see, my objective, if you guys are in consultancy tomorrow, your end objective is to ensure that you make the maximum money for your company, right? KPMG, Deloitte, Big Fours, and everyone. How will you increase your savings?
Tell them I have a 500 of savings.
Sorry?
Tell them I have a 500 of savings.
I just can't tell them, na. I have to tell them how will I save, how will you? End of the day, that 500 rupees should reflect in their bank account. They're talking about cash saving. They don't want on paper saving interpretation, you know. How will you do it? उनके PNL में दिखना चाहिए. Their PNL should reflect that 500 rupees of saving. How will you do it? Come on. Think. You guys know it, but you just are not thinking the right direction. How will you do it?
Sir, operational savings,
Can you little bit elaborate, Naomi?
like production cost, reducing production cost, like energy costs, labor
You
cost.
already spoke. You have optimized everything. How do you make 100 rupees saving to a 500 rupees saving without changing your operating activities?
Investing.
No. Investing is altogether a different activity, na? That's a
Is,
revenue element.
but it
Revenue
adds to
element
the
mein I'm not
revenue.
getting the money. Come on, think differently.
Sir, you automate a labor-intensive process.
You have done that automation also.
Launches,
Layoff.
You have done everything. I am talking आप लोगों ने एकदम process को optimize कर दिया है. You have automated the process. You have optimized. You have done layoff. You have increased the productivity of people and all. After that only you achieve to that 100 or 1,000 rupees, right? How do I make that 1,000 rupees 10,000 rupees? Agar if I have to convince my client that okay, this is not 1,000 rupees saying, this is 10,000 rupees saying, how will I convince my client?
Sir, opportunity costs.
Can you elaborate on that? You are somewhat correct, but can you elaborate on that?
Yeah, basically taking this course of action resulted in like future costs which are not going to be incurred.
That would be a
Something like that.
justification of how you're saying 1,000 rupees, right? Okay.
Right.
I'll tell you, I'll give you a simple example. Okay, there's no rocket science in this. Okay, understand. Jio and Vodafone. Okay, I'll take this example. The postpaid plan of Jio and Vodafone are different values,
Yes, sir.
correct? Vodafone plan back in time used to be at 399 per month minimum, correct? And Jio was at 149 rupees per month minimum. Okay. You guys suggested that, okay, you're giving your employees a Vodafone card, shift it to Jio. So 400 minus 150, that is 399 minus 150. How much money are you saving?
Can you repeat?
How much?
Can you repeat? I couldn't.
Vodafone postpaid plan. You know, companies give mobile phones to their employees, correct?
Yes, sir.
Yes.
Vodafone billing plan starts at 399 and Jio starts at 149. So what will you suggest your company if they are using Vodafone?
Switch to Jio.
Switch to
Switch
Jio.
to Jio. You will advise them to switch to Jio. If they switch to Jio, how much money they will save?
250. 249. 248.
249. Let's go with round figures to be simple. 250. Okay.
250.
So in the first year, they will save 250. What in the next year?
500.
What in the year after that?
Goes on.
Right? Now understand. Savings are of two types. One is a one-time saving. Okay. Something which is, let's say, this year I will not, let's say if I want to increase my profit, this year I will not travel. I will not give parties to my employee. That becomes your one-time savings. Correct? But switching the plan from Vodafone to Jio, that's a perpetual saving. Right? So that means I will tell company, okay, I showed you something which for your future 10, 20 years, this is a saving, that 250 rupees. Right? This is how we play with the time value of money. I will tell the company, I'll tell you simple thing, okay? Let me open an Excel. Understand that? Yearly savings is 1,000. Okay. And multi-year savings, if you have to calculate, if something is for limited period in time, that would be a calculation different. I'll show you, but I divided this by discount factor. You know what do you mean by discount factor? Discount factor is nothing but cost of capital. Okay. My capital consumption will reduce by 1,000 rupees every year. Correct? Can you see that 1,000 rupees became how much?
11,100.
Because I have applied a perpetuity formula. 1,000 became 11,000. This is how you make money in consultancy, guys. This is how, because see, when you tell someone you're saving 1,000 rupees on a turnover of crores of rupees, he might not be interested. Correct? You know, sometimes we ignore material. Let's say, it's just 2 rupees cheaper, just forget it. Correct. But if you tell them it's not 2 rupees, it's 20 rupees cheaper, he might actually think it. Understood now this thing? The formula that I have applied is nothing but a time value formula. Perpetuity formula for time value is something that I have used. Everyone clear on this concept? Conceptually, I mean the more than concept, are you clear on the example that I gave you?
Yes, sir.
Are you guys able to relate it to Jio, Vodafone and all, and how did I calculate my savings? Okay.
Yes,
Now
sir.
let's look at present. What do you mean by present value?
The current value of the money.
Current value.
That means if I'm gonna receive 1,000 rupees 10 years down the line, like for example, if I'm gonna receive 11,000 rupees after 10 years, the value of that 11,000 today is how much? Only 1,000 rupees. Correct? Now, how do you calculate the present value? It is nothing but future value. That means the money that you're gonna receive in future divided by 1 plus r raised to n. Okay? Now, so any cash flows that you have, okay, can you read this example? Can someone read it out loud?
Calculate the present
Hmm.
value of $1,331 to be received 3 years from now.
Okay. That means how much money have you receiving after 3 years?
1,000.
0.331.
Okay. And what is the discount factor?
10%.
10%. That means cash flows divided by 1 plus, what is the percentage you guys told me?
10%.
10%.
Power n. Power 3.
Raised to,
Power 3.
why am I doing 3?
3 years down the line.
That means that value of 1,300 rupees. Okay, today. The value of 1,300 rupees that I'm gonna get in 5-10 years, the value of that is how much? 1,000 rupees today. Clear? Yes or no?
Yes, sir.
This is what you mean by the present value. Clear, everyone? Now, there's one more way to
Yes.
calculate. Let me just show that to you. In the exam, guys, there is something called as the present value table that will be given to you. This is the formula sheet that will be given to you in the exam. I don't think this notes has that, but along with that, you also get something which is called as a present value table. Okay, let me just figure out something. The exam, guys, there are formulas that are given to you. Okay. Now I think this is an answer sheet. Yeah. This is the formula sheet that will be there. Along with the formula sheet, you also have a present value table. Okay. And you also have an annuity table. First, let me tell you how do you read an present value table. Okay. This is your number of
Yes.
period. Okay. Period over means the number of years. We are not talking about anywhere in AFM of the calendar year. Okay. First year, second year, third year. That means I'm not talking about 2023, 2024. No. We talk about first year of business, second year of business, third year of business. Okay. In the question that we saw right now, how many years am I getting the money in?
Or year end.
Third year. And then what was the rate of discount?
10%.
So what is the value that you can see over here?
0.751.
I'm getting same 1,000 rupees as the answer.
Yes, sir.
Okay. In the exam, guys, I don't expect you to do 1 plus r raised to n. No, I don't expect you to do that. I expect you to use the present value table. It saves time. Okay. But you guys need to know, because tomorrow, like I told you, right, the example of the savings that I gave you, Jio, Vodafone, when you go into business consultancy and you have to ensure that you make the most out of the savings, you will have to use your present value tables and everything. Clear?
Okay, sir.
Have you guys heard of annuity before?
Sir.
Have you guys
Yes,
heard
sir.
about annuity before?
Yes, sir.
What do you mean by annuity?
Constant cash.
Okay,
Cash flows for a definite period.
Sorry?
Cash flow for a definite period, like 10 years or 15 years.
Okay. Something which gets a repeated cash flow. Okay. Something which gets a repeated cash flow is, you call it as a
Annuity.
annuity. Let me give you an example. Let's say your rent. Okay. First year, second year, third year, fourth year, fifth year. Just an example. Let's say every year you're getting 100 rupees as rent. Okay. Discount factor at, let's take 10%. So we will calculate the present value. Okay. And this is the net present value. Net present value is nothing but the total of all your present values. Okay. We know, let me now present this table. At 10% at first year, what is your discount factor?
9.909.
0.909. At second year, what is your discount factor?
0.826.
0.826.
Seven.
0.751.
0.751. Fourth,
683.
then,
621.
so what is the net present value?
379.
379. And what was your actual total cash flows?
500.
Okay. Now let's look how do you do it using annuity. Okay. Annuity is nothing but a cumulative of this. That means Clear? Now, you guys are given an annuity table over here. Can you see the annuity table?
Yes, sir.
Okay. How do you use it calculating the annuity? Let's say at 10%. How many times is your cash flow getting repeated?
5 years.
3.791.
5 years. Okay, like this said, 1,000. Over here, calculate the present value of 1,000. Okay. How much are you getting? So what is the value over here?
791.
What is the annuity value of this?
1,895 per
1,895. Okay. You're gonna receive 1,000 rupees. Okay, sorry. Over here, you will not multiply it with 500. Over here, you will multiply it with just 100 over here. Are you getting the same answer?
Yes, sir.
Are you guys getting the same answer?
Yes, sir.
That means something when you have something in repeated. Okay. You cannot apply the annuity formula when you say 1 year you have 100, then you have 50, then you have 200, 20. No. When there are unconventional cash flows, that means that if it is not constant, you cannot apply an annuity. Clear, everyone? Anyone has any doubts, guys, still here?
No, sir.
What do you mean by perpetuity, guys? Any idea?
Same cash flows, but forever. Infinite period.
Constant growth rate.
Whenever, let's say there are two kinds of investment. Okay. One, for a specific period. Let's take a real estate. When you are constructing a building, that project is for 4 or 5 years only, correct? Technically, yes or no?
Yes, sir.
That project will be for only 4 years or 5 years only, correct?
Yes.
But when you're investing in a company, does that mean the company is going to stop the business in 3 years or 4 years? Does that mean the company business is going to stop in third and the fourth year?
No, sir.
No. You don't know. Have you guys heard of the concept going concern?
Yes, sir.
Right? What do you mean by going concern?
The
Company
continued
will be able to
operation.
run for the foreseeable future.
That means company will be surviving in the foreseeable future. That means you don't know when is an end for that. When you can't see an end for something, we call it as a perpetuity. Correct? Yes or no?
Yes, sir.
Yes, sir.
When you can't see an end for something, it is called as a perpetuity. Correct? Similarly, this is an example of perpetuity. Cash flows divided by discount factor. That means, let's say this is the cash flows divided by 10%. This is your perpetuity. Clear, everyone? That means if you're making 1,000 rupees 1,331 in future, the value of that money today is 13,000. Clear?
Yes, sir.
Cash flows divided by R, okay, is known as a perpetuity. Because
Perpetuity.
there's no end to it. Now, I cannot put a numerical raised to 2, raised to 3. No, because there is no end to that period. Clear, everyone? Any questions, any doubts here? Guys, anyone has any questions, any doubts still here? Now, let's talk about delayed perpetuity or delayed annuity. Okay, let's take this very same example. Whenever you start a new business, do you think it is always possible that you will start making positive cash in the very first year of business?
No.
Yes or no?
No.
Sometimes what happens is just to set up the company, it takes 1 or 2 years, right? You have to construct a plant, you have to buy machineries, you have to get everything operational, you'll have to hire people and all of those things, correct? Yes or no? Right? So let's say there might be time where you don't get a cash flows in the very first year of business. You will start getting it from the second year of business. Okay. This is something we call it as delayed annuity or delayed perpetuity. Okay. Now, when there is, can you see over here in this formula, in the first year, I've made the cash flow as 0. Why? Because the cash flow is coming in from the second year onwards. Okay. But but if I apply a annuity formula over here, I'm getting answer as 379. Guys, this table over here. Okay. And these two answers over here. Okay. These two has to always tally. If you get confused in the exam, use this table. Go year on year. Nothing wrong in that. You're not losing any marks. Nothing like. This is a very basic. This is a little advanced. Okay. Now let's say delayed annuity. What do you mean by delayed annuity? Delayed annuity means that your cash flow is not starting for year 1, but is starting from year 2 onwards. In that case, what we do is we take the number of times the cash flow is getting repeated. How many times the number of the cash flow is getting repeated?
4.
4 times. So what is the annuity formula for 4 times? 3.170.
3.170.
But when you discount it by 3.170, it will bring you from year 5 to year 2, right? What about this year? You need to get to year 0, right? Yes or no? You need to get over here. Year 0 is nothing but your year of investment. Correct?
Yes, sir.
And in year 0, the discount factor will always be how much?
1.
Why?
Because
Present value.
Value.
The value of 1 rupee today is 1 rupee only. It's not going to change. Right? That's why you have discount factor at 10%. Okay. Now, but when I discount it for these many number of years, I come to year 4. Then what I'll do is I'll multiply it with by the an year before the cash flow is getting started. When is my cash flow getting started, in which year? Which is 1 year before my cash flow coming in?
First year.
First year. So number of times the cash flow is getting repeated, multiply it with the 1 year before the cash flow starting present value. Can you see now I am getting the same answer? Everyone understood this?
yes, sir.
Okay. This is the difference when we talk about basic and advanced. We will have a lot of scenarios coming in the exam where I would say not the whole business. Okay. Business may have from year 0. Some cost may come from year 2. Some savings may come from year 3 onwards. Tax may be paid in advance or arrears. Right? So all of these things you'll have to understand what do you mean by delayed and all. Clear, everyone?
Yes, sir.
Any questions? Anything till here? Any doubts anyone has? Can you calculate this one, illustration 4? I don't want you to see the answer. Can you tell me what will be the answer and how will you calculate using the formula? Read the question. It's a very basic one, but I still want you to do it. It's a perpetuity one. Annuity one I have already showed you. Everyone knows the formula for perpetuity, that is cash flow divided by R is perpetuity. And you need to find delayed perpetuity. Whenever you find a delay, keep one thing in mind. Delay means you're going from year 5 to year 1 whenever you discount, whenever your first cash flows end. So 1 year before the discount factor is something that will give you the answer. Everyone got the answer? Naomi, Sashidhar, and Aaron.
8537.
How much?
8537.
No. Understand, this is a perpetuity with a growth. Okay. Now understand this thing. Perpetuity with growth formula is cash flows into 1 plus G divided by R minus G. Okay. Now, what is your cash flows?
1000.
1000. What is the growth rate?
2%.
That is nothing but 1 plus G.
Yes, sir.
1 plus G is how much?
1 plus 1.02.
1.02. Okay, divided by discount factor. What is your discount factor?
10%. Oh.
Date.
R minus G, you do it. R is nothing but your discount factor. That is rate
10%
of interest. So you have done 1, that is 10% minus 2%. Clear till here? Now let me put this formula for you. What is the cash flows? 1000. Now guys, you guys need to be very careful with the brackets over here, right? Because when you're doing it in Excel, bracket plays a very important. 1000 into 1 plus 2%. Okay. Divided by 10% minus
2%.
2%. How much did you get?
Sir, what I did was I didn't do 1 plus G into cash flow. That's
But
where I
my
got.
answer is still coming wrong. Can you tell me why?
Present value factor.
Present value factor we get. Yes.
Present value factor. Which year is my perpetuity starting?
End of year 5.
Oh, yeah.
In year 5. 1 year before year 5 is which year?
4.
Fourth year.
4 year, the discount factor is how much?
0.68.
0.68.
I got the answer. Because when I discounted the perpetuity, I came to year 4 end. But from year 4, I need to go to year 0, right? Yes or no? Clear, everyone? Any questions still here?
Can you explain why 4 years and not 5 years?
Okay. Perpetuity starting in which year?
End of year 5.
End of year 5.
in year 5. When you do your perpetuity discount, it will get you to the end of year 4. Because from year 5 onwards, your perpetuity is starting, right?
Yes.
1 year before your annuity or perpetuity starting is which year?
The 4th year.
4th year. So whenever you discount something, we are not talking about calendar years over here. Now we are talking 1st year, 2nd year of business. When you discount the perpetuity from the 5th year of business, it will get you to year 4. But what is your objective? You need to get to year 0, right?
Yes, sir.
You don't need to get to year 4. You need to get to year 0. From 4 to 0, how will you get it? By discounting it with the present value. Okay, if
Right.
in the 4th year I'm getting 12,000 rupees, what is the value of that 12,000 rupees today? Correct?
Got it, sir.
Sorry?
Yes, sir.
Clear, everyone? Any questions, any doubts still here? Everyone clear?
Yes.
Okay.
Sir,
Is anyone who's conceptually not clear or something? Because again, this may seem very basic, but this is very critical for you guys when we do technical questions. These basics are something that's going to help you. Clear,
sir,
everyone?
sir,
Yeah.
I have a doubt.
Sorry?
Sir, I have a doubt.
Yeah, please go ahead.
So end of the year 5 means we should look at the 5th year of in the discount, the present value table.
No. Understand. That's what I'm telling. You're not talking about the calendar years. You're talking about 1st year of business, 2nd year of business. Okay. When you discount a perpetuity, all the cash flows that we are seeing is as at end of the year. Okay. When we say the perpetuity is starting in 5th year, that means in the 5th year end. Your objective is to get at the start of the 5th year. Correct? You're with me till here, Hariharan?
No, so the last line I was confused.
Sorry?
Could you repeat
All
it?
the cash flows are as at year end.
Yes, sir.
Okay. Your question is correct. Okay, that means I need to discount with 5th year. Because I need to know to get to the start of the year, right?
Yeah.
But the cash flow are as at end of the year. Can I say the
So,
end of 4th year is equivalent to the opening balance of 5th year?
no.
Correct? Closing of 4th year is equal to the opening of 5th year,
Yes, sir.
right? We are over here not trying to calculate the cash flow for the 4th year. We are trying to calculate and get to the start of the 5th year. Start of the 5th year is nothing but the close of 4th year. Clear?
Yes, sir.
That's why we take 4th year. Understood now?
Oh, thank you, sir. Sir, could you go to the PV table?
Sorry?
PV table.
This one?
No, sir, the present value table.
Yep.
So the 10% at 4th year, the 0.683 is at the end of 4th year. We are
End of
calculating
4th year.
at the end of the 4th year. We are calculating for the start of the 4th year.
Everything that we calculate in the whole of cash flows is end of the year.
Yes, sir. We at the end of the year we are calculating from start, so we are discounting it at 0.683.
Correct. So end of the
Okay,
previous year, we are assuming it's the opening of the next year.
Okay, sir.
Okay. Because see, whenever you start a business, revenue you will not get at the start of the year, no?
Yes.
Start of the year, may will not get the cash flow. You'll get always at the end of the year when you do your sales and everything, right? So all of the calculations that we are doing is as at end of that particular year.
The calculations are we are doing it at the end, but it is for the start.
Correct.
Okay, sir.
Clear? Because see, when I come to year 0, that means I want to know if in first year I'm making money, what is at the end of this year I'm making, because I'm investing today, right? Clear?
Yes, sir.
Any questions still here? Guys, any questions, any doubts still here?
No, sir.
Everyone can hear me, guys, or was it? Guys, can you hear me clearly?
Yes, sir.
Yes,
Good.
sir.
Okay.
Yes.
Let's talk about inflation over here. Okay. How do we deal with an inflation? What do you mean by inflation? Guys, what do you mean by inflation?
Rise in price.
Prices of goods and services rises.
Now, see, we are over here trying to do an investment appraisal, correct? When we are doing investment appraisal, that means I cannot assume the sales price or the cost price and everything to be the same every year, correct? With the inflation,
Yes,
this
sir.
price will also go up or come down.
Mhm.
Yes or no? Yes or no,
Yes.
guys?
Yes, sir.
Yes, sir.
With inflation, this price might go up, come down, and everything might happen, correct?
Yes, sir.
So typically, whenever we are doing our calculations and all, we need to ensure that our cash flows and sales price, cost price is everything adequately covered and inflated, right? Now, inflation can be of two types. Okay, one we call it as a real method, and one we call it as a money method. Okay. I'll first tell you what do you mean by money method. Money method, what happens is you individually go and inflate each and every line items, right? That means you'll inflate your sales price, you'll inflate your cost price, you'll inflate your overheads, correct? Because see, every cost has a different percentage of inflation, correct? Because the price of tomatoes and onions may not go up by the same percentage every year. Everyone agrees to that?
Yes.
Yes, sir.
That means you'll have to specifically increase the value of onions and you'll have to specifically increase the value of tomatoes. Okay. But end of the day, every country gets their country inflation rate. That is nothing but average of all your commodities percentage. End of the day, they also calculate the country inflation. Correct?
Mm.
Because whenever you're doing any working and all, and there are multiple products involved, technically, I cannot tell one country that, okay, the price is going up by 7% for tomatoes, onions for 8%. No, I would rather say, okay, my country's inflation rate is 7%, right? Why do you think it is important to know what is your country's inflation rate? Why do you think it is important to know the,
To manage our cost,
sorry,
to
Purchasing.
manage the cost
to manage the,
Cost.
of running the
correct. And one more thing, when you guys go to the work tomorrow, you need to ensure that your increment is more than inflation, correct?
Yes, sir.
Otherwise you will end up making loss,
Mm.
yes, sir.
right? So your country's inflation is more important, correct? Similarly, because see, that time I cannot go to my employees and say, okay, fine, I eat tomatoes, my inflation rate is 7%. No, that is not a practical way to ask for a increment, right? So for that, you need to know the country inflation. Because boss, the cost of living is increasing by 7%. I minimum need to get a 7%. Right. Overall inflation is something we call it as a real method. That means what I'll do is I will not go and inflate individual cash flows. That means my sales price, variable cost, fixed cost, and all of these things. I'll not go and inflate individually. Rather, what I'll do is I will take a specific percentage. I'll do my normal calculation, and last may I'll apply that percentage to my cash flow. Clear, everyone?
Mm.
Okay. From an exam standpoint, if there is specific inflation given to you, you will always use the money method. Okay. See, money method becomes impractical when you have to inflate in perpetuity. You cannot inflate each and every line item for 100 years, correct?
Yes, sir.
Practicality is also something, right? You cannot inflate each and every line item 100 for 100 years. That's when you use a real method. Clear? But if you have a limited time project of 5 years, 10 years, obviously you would want to be more specific. When you want to be more specific, you will use a specific discount factor. Clear? With me till here? Any questions?
Sir, so in real method, there is the same inflation percentage for all the items. In money method, it is different for different items.
Correct. In real method, you will discount, you will inflate your free cash flows. That means after calculating everything, whatever money is there, you will directly apply. If I have to tell you in normal terms, you will apply it in your net profit. But money method, you'll apply it to your sales, you'll apply it to your variable cost, you'll apply it to your overheads, and then arrive to a net profit, inflated net profit. Clear? Okay. So guys, what happens is if you are using money method, you need to ensure your discount factor is also inflated. Okay. And you need to ensure that your discount factor is also inflated with the money cost of capital or the real cost of capital, whichever you're based on. Clear everyone till here? Any questions, any doubts? Yes, no. How do you calculate 1 plus I is equal to 1 plus R into 1 plus H? That means I means money, R means real, H means inflation. If you want to arrive to a money cost of capital inflated, it is nothing but 1 plus real cost of capital into 1 plus inflation. Now, using this formula, you might be sometimes given money cost of capital and you need to calculate real cost of capital. Using the mathematical equation and just plotting the numbers in the very same formula, you can do it. Clear? Now,
Yes.
can you read this? Nominal takes the currency monetary value. Okay. Real takes into account the effect of inflation.
inflation.
Okay. Presents the current headline monetary figure. Provides a guide to actual purchasing power or the opportunity cost of workers. Clear, everyone? Any doubts still here?
Not understood.
Everyone with me?
Sir.
Okay. Let's take a quick.
Sir.
Yes.
Sir, I couldn't understand.
Which part?
The nominal and real.
Which can be a little bit louder, Hariyan. Your voice is a little vague.
Okay. Sir, can you explain the table? I couldn't understand.
Okay.
The
The
different
table is
figures.
nothing but table is talking on what we just spoke about, right?
Okay, sir.
Nominal method, you use each and every line item and inflate it.
Okay.
Real method, what is it? Provides an actual guide to purchasing power. That means, whenever you see a foreign employee earning double money than you have seen, right? Foreign employee earning double money than you.
Yes, sir.
But then we say, okay, over there, the rent is also double. This is also double. That means the purchasing power, the cost of living is also higher in that country.
Okay.
Okay. So this is nothing but it talks about overall purchasing power in that country. The overall inflation in that country. Clear?
Yes, sir.
Okay. Let's take a quick 20 minutes break and then we'll be back and we'll be going into detail in calculation of NPV. Okay, guys?
Okay, sir.
Okay. Guys, we'll start in 5 minutes. Okay, guys, let's start. Is everyone back? Aaron, Yati, Daksh, Divesh, are you guys back?
So,
Naomi?
yes, sir.
Yes,
Okay.
sir.
Yes, sir.
Now, let's understand how do we calculate an NPV, okay, guys? I'll come to this working capital tax and everything later on. But let's just first understand the format. Okay. Now, guys, two things to remember over here. This is our primary format of calculating an NPV. Okay. Whenever you see an NPV related question in the exam or anywhere, the very first thing I want you guys to do is just put up this pro forma. Okay. We will put up the pro forma and then we will just fill in the blanks. If we just fill in the blanks, we will automatically start getting the answers. We do not have to apply our brains. There's no rocket science. It's all, we will be concentrating more on basics. Okay. And with that basics, how do we get to technicals is something that we go. Because see, technicals will carry 2 or 3 marks, but basics has the major portion in the whole of the question, right? Because if your basic is correct, your technical answer will automatically be correct. Okay. Now, what is an NPV? What is a free cash flow? Free cash flow is nothing but a P&L, that is profit and loss statement of the cash. Okay. That means any cash item. There are two kinds of profit. One is your net profit and one is the cash profit. Correct? So NPV is nothing but we will try to calculate what is our cash profit gonna be. Okay. So we will incorporate all the cash flows. We'll incorporate all the cash related items and everything over here. Clear? Yes or no? Okay.
Yes.
So we will start with our operating revenues. That is what is my revenue. Then we have our cost. We'll come to our net operating cash flow. We'll come to taxation. We'll do our initial investment. Now, initial investment, if you see, guys, we have plotted this in year 0. Can you tell me why?
Because it happens at the beginning.
It's
Correct.
required to run the business.
Correct. I have to do an investment in year 0, set up the company, do everything so that I can start getting the cash inflows from year 1 onwards. Correct?
Yes.
Clear, everyone? Okay.
Yes, sir.
Then we have our scrap value. Why do you think the scrap value is in the last year?
Because it is sold.
Sold at the year end.
What is scrap?
Value at the year end.
Residual value.
Residual
Scrap
value
is
of a
nothing
non-current.
but the machinery that you sell when it is no longer in use. Correct? When will your asset be no longer in use? When you stop the operations. Correct? You stop the operations in the last year of business. Correct? Clear, everyone? Now, the negatives reflect the cash outflow and the positives reflect the cash inflow. Okay. So if you see revenue and all, it's all a cash positive and all other are cash negative. Working capital and tax, we will discuss further more in detail how to do it around. If you see, those are the only two workings where we have a working note. Can you see that working note? Because uh, when you look at ACCA sample questions and everything, you might find the taxation and working capital working done in the very same answer. But trust me, it is very wise to have a separate working note for tax because in the whole of calculation, working capital and the tax carry the most amount of marks. Okay, because these are the places where you will have technical adjustments to be done. Rest all is nothing but sales price multiplied by quantity, sales price, quantity multiplied by the cost will give you the operating cost and all. No rocket science there. But taxation and working capital is little different. Working capital, if you see, it starts in year 0, 1, 2, 3, and in the last year it is positive. We will discuss in detail why is it that way. With all of this, we come to free cash flows. That is the cash, net cash balance left for my disposal. Uh, have you guys heard of the term disposable income?
Yes,
Have you
sir.
guys heard of the term disposable income?
Yes, sir.
What do you mean by disposable income?
Money left for spending,
Money
saving.
money left for your spending after deducting all the tax and everything that is there. Correct?
Yes, sir.
Yes, sir.
Clear, everyone? Okay. Now, Let's come to the tax working. So tax, do you know people, do you guys know how do we calculate tax? How do we calculate tax, guys?
Taxable profit multiplication of taxable rate.
Taxable profit multiplied by the
Taxable rate. Tax rate.
taxable rates. Okay. Now understand one thing. We are over here dealing with cash profit, correct? We all know depreciation is a tax allowable expense, correct? As per the tax rules, okay, in any government or anywhere in the world, depreciation is a tax allowable expense. Clear? What do you mean by tax allowable expense?
Deductible for tax.
Sorry?
Deductible.
Deductible for
Deductible.
tax
That means
on the income.
for every depreciation, I can bring down my profit to the extent of depreciation, and on that, I have to pay the tax. Correct?
Profit minus tax.
Right? I can bring down my profits to that extent, right? Because it is allowable as per the tax. Clear, everyone?
Yes.
Any questions still here? Any
Sir?
questions? Anything till here, guys? Yes, no, confused, lost.
Sir,
Yes.
sir, so bringing down that profit to tax to the extent of tax means subtracting the depreciation from profit, right?
Correct, correct, correct. That's true. That's correct. That's exactly what I meant. Clear?
Sir.
With me, guys, still here, everyone?
Yes, sir.
Okay. Now, tax allowable expense means this particular thing. Now, what do you mean by taxable profit?
Net
Once we
profit.
arrive to that, after that, we do a taxable profit. Now, depreciation, we all know is a non-cash item, right? Yes or no?
Yes, sir.
Okay. The reason I do it separately, guys, is because what happens if you do it in main calculation, you have to reduce depreciation from your net operating cash flows, calculate tax, and then you might have to add back the depreciation, right? Because it's a non-cash item. So it should not be a part of your main pro forma working. So in your main pro forma, depreciation has to net it to zero. Understood? But rather than making a chaos over there, we would rather do it as a separate working and gain full marks over there, where we'll say, okay, this is my operating profit, this is my depreciation, I come to my taxable profit, and we do a tax charge. Okay. Keep one thing in mind. The key concept over here to remember is that tax is levied not only on only on profits, not on cash flow. Correct? So that's why we do it as a separate working. Now keep one thing in mind. We'll go to the tax working also in detail when we solve the question. I'll tell you how to calculate depreciation and all. But there's one thing to remember. Tax can be paid in the same years or in arrears. What do you mean by arrears?
Next year.
Next year.
Current year tax to be paid in
Next
next year.
year.
That means year one tax to be paid in year two. So you need to be very careful when the question says, okay, whether it's in arrears, whether it is in advance, or how is it. Clear? Okay. Now let's come to working capital. Working capital is an income or expense.
It's not an income, it's not an expense.
It's not an income, it's not an expense.
Expense.
Then why are we having it in our working? Why are we having it in our working then?
Sir,
The cash flow has
Sorry?
occurred. Because the cash flow has occurred
Day-to-day
due to the work.
operation.
No. Doesn't matter, na. Even if it's for day-to-day operation, it will not impact my bank balance, na, because end of the year mein to it will come back. What is a working capital cycle? You buy raw materials, You manufacture, you sell,
Manufacture.
you get your receivables at the end of the year. If I'm
Okay.
talking at the whole cycle, start to end, I will get my money back. If I'm getting my money back, then why is it the working capital in my working? Now look over here.
Time value of the money, the
Time
time
value
between
over
the
here. Yes. Because see, you're blocking your money in year one. I understand that you'll get your money back in end of year one, but you'll have to reinvest that money for year two, right? You'll have to reinvest it for year three, year four. When you stop the operations, that's when you get your actual money back. Understood? Everyone with me? Yes, no, confused, lost. Everyone with me till here?
Yes,
Yes, sir.
Okay.
Yes.
Understand one thing. Working capital is something that you require at the start of the year, correct? If I have to get a 1,000 rupees revenue in the start of in end of year one, that means I have to invest some money at start of the year. Yes or no?
Yes, sir.
So if I want to invest at the start of the year one working capital requirement, I'll have to put it in year zero
Yes, sir.
because I'm talking about cash flow that's at end of the year, right? Okay. Now, can you read this example? I'll give you a minute. Then I'll explain you the working. Everyone done reading? Okay.
Yes, sir.
Now look at this. What does the question say? Can someone tell me what does the question say? What
The
does
working capital is required 10% of sales.
10% of sales?
The
Okay.
sales would be 3 lakh, 4 lakh, and 5 lakh for 3 years.
Okay. First year sale is how much?
3 lakh.
3 lakh. Let's okay. That means how much working capital will I need?
30,000.
30,000. Okay. I'm very clear. I will put 30,000 in the year zero. Why am I putting it in year zero?
Because it
Out of
requires
the
at
year.
the
Because
start
I need the working capital at the very start of the year.
of the year.
What is my next year working capital? Revenue?
Or
40,000.
4 lakh, right? So my requirement is how much?
40,000.
40,000. Now look at this. This is my requirement. But what goes in my pro forma is the working capital required. Okay, see. I already invested 30 in first year.
Yes, sir.
In year zero. That means end of year one, I'll get that 30 back.
Yes, sir.
It's a working capital. It's not an income or expense. Once you sell the goods, you get all your working capital that is blocked back. So once you get that back, next year, what is your requirement? 40.
10.
You got 30 from year one. So how much additional you need to put in?
10.
10.
So we have put in 10 over here. Next year, what is my sales?
500.
50.
500.
500. What is my requirement?
50,000.
50,000. How much have I already invested?
40,000.
40,000. So how much additional I need to put in?
10,000.
10,000.
10,000. What will happen in year three?
So we will get back our
We will get back all the money back. Correct. Because not an income and expense. I've shut down my operation. I've done my sales. All my goods are sold. And then I'm getting my money
back.
Clear everyone over here? Okay.
Yes,
Now,
sir.
this is the format for annuity where we have our cash flows constant 1 to 3 years and we use our annuity factor. Okay. I will quickly go through. Now, understand, guys, your NPV calculation and everything is based on assumptions, right? Yes or no?
Yes.
You are predicting that you're gonna do a sales of X amount. You're predicting you wanna do a revenue of X amount, right? Are you sure you wanna do that?
No, sir.
You're analyzing the project just to get a high level estimate. Yes or no? Right? So that means obviously if I'm doing something on assumption basis, it will have its own merits and demerits, correct? Now, guys, all the theory, okay, you will also need to know the merits and demerits of all the financial models. These all are called as financial models. Why? Because see, you are advising the board of directors whether you should go with that investment or not go ahead, correct?
Yes.
But you need to also tell them what is your basis of that, correct? For them, rather than knowing that whether it is profitable or not, they also need to know whether that assumption that is being used to arrive and see whether the project is profitable or is also realistic or no, correct? If you tell someone I'm assuming 100% of the sales and tell them the project is profitable, tomorrow when the project starts, who's the one who's gonna be responsible? We are the ones who's gonna be responsible, right? So we need to be clear on that. Okay. So what are the advantages of NPV? First of all, it is based on profits. It is not based on profits and based on cash flow. Why is this an advantage?
Because profits can be manipulated.
Profits can be manipulated.
Correct. Profits can be manipulated. Now, when we talk about manipulation, we are not talking about fraud over here. Okay. We are talking about interpretation of the accounting standards. You can interpret an accounting standards in multiple ways. Correct. Like, for example, you can do an expense in such a way that it qualifies for a capital expense. A capital expense means something you are doing it for purchasing the assets. And we all know if it's a capital expense, it goes to your balance sheet. Correct? It will give an upside to your P&L, though it will come in the form of depreciation. But if you incur 1,000 rupees today, the whole 1,000 rupees will not come to you in P&L today. So you structure your transactions in such a way, okay, that you're maximizing the profit in your P&L. With me, everyone? Okay. It takes into account the time value of money. Obviously, it takes the whole project, the whole time value of money and all. Right? Then it considers the entire life of the project. What do you mean by considering the entire life of the project? That means it's
All the
consider
cash
the whole,
flows.
yes, it considers the whole cycle of the project. If the project is for 5 years, it will ensure the whole 5 years cash inflows, outflows is considered. If the project is for perpetuity, we all know how a perpetuity works, right? Yes or no? Perpetuity, we use the perpetuity formula and we ensure that the whole project has been considered. Okay. It is in line with shareholders' objective of maximizing wealth. Can you tell me how? Can you tell me how is this model in uh towards maximization of shareholders' wealth? How does this maximize shareholders' wealth?
So
Positive
We
NPV
can.
lead to
Sorry?
so based on NPV, we are going to decide whether we are going to take the project or not. So if it is negative, so we are not going to take the project, right? So that's why the primary objective of man.
How?
We can estimate the returns
See,
from the
understand.
project.
What is the indicator? Okay. What is the indicator that tells whether the shareholders' wealth is growing or not growing? Which ratio do you use?
PE ratio,
Earning per
Earnings per share,
earnings per share.
EPS. Right? Every share, what is the money that I'm making is something that tells me What is the formula for earnings per share?
Earnings
Earnings
before
dividend.
interest and tax.
Earnings divided by,
Number of
Shares
shares.
outstanding shares.
okay. Now, if I invest in positive NPV projects, will my earnings goes up?
Yes, sir.
If my earnings goes up, my EPS goes up.
Hmm.
If my EPS goes up, my shareholders' wealth will automatically go up. Understood?
Yes, sir.
Now, what are the disadvantages of this model? See, till now I'm talking about cost of capital, discount factor and all. Do you guys know what it is?
Hmm.
Do you guys know in detail what do you mean by discount factor? How do you calculate? What is the risk adjusted discount factor? Do you guys know it? If you have to explain it to someone, will you be able to explain it? I'm sure you guys know what a
No,
discount
sir.
factor is. I'm not denying that. But will you be able to explain it to someone?
No, sir.
No. We are over here to learn it. Correct?
Yes.
Now look from a perspective that when you're using discount factor and all, and you have to explain it to a sales guy or a CEO, right? CFO might understand. He's from a financial background. But if you have to explain it to someone from a non-financial background, do you think he will understand what do you mean by cost of capital? No, right? He might have no clue what it is. And our job is to support the non-finance guys, right? The sales guys, the operation guys, giving them insight, telling them which is your actual savings. Like, for example, operations guys will say, okay, fine, I have done savings. I have reduced my employee. Okay, let me take an example. Let's say you fired one employee in the month of November. Okay, that means will you have a savings in November or will you not have a savings in November?
I have savings.
Sorry?
Will have savings.
No. A normal operations guys will say, I have removed this employee. I will get savings in November. But think from a finance perspective. We all know as a process that whenever an employee leaves, you have to pay him a full and final settlement as a one-time expense, correct? Where you
Yes,
pay him
sir.
for his outstanding leaves, you pay him for his gratuity, you pay him for his outstanding salary and everything, correct? Technically speaking, you will pay a one-time settlement in the month of November. So you'll not get the savings in November, right? You'll start getting it from December, right? Understood, guys, till here,
Yes, sir.
right? So this is where we as finance guys comes in to tell the operation guys, ki boss, you have done a good job. You have done everything right. But try and understand there is something called as P&L savings and there is something called as cash savings. Correct? There are two kinds of saving, right? An accounting adjustment will give you a P&L savings, but it will not give you a cash savings. With me till here? Understood? Any questions? Any question, guys? Okay. It can be misleading if you're trying to evaluate projects with different life cycles. That means, I'll give you an example, okay? Let's say project 1, project 2, NPV 1000. This is for 10 years, 1500, but this is for 20 years. If you have to make a decision based on NPV, which project is giving you highest NPV? Project 1 or project 2?
1.
Why 1, Naomi?
Because in 10 years, I'm getting 1,000. And in 20 years,
But if you're a finance guy, you know this. But if you're telling someone, what will he say? Why are you telling me 1000? Why not? This project is giving me 1500. If you talk in money terms, project 2 is giving you more returns. But then you'll have to explain that guy that boss, this project is only for 10 years. That means every year I'm making 100, whereas in project 2, every year I'm making only 75. Correct? With me till here, guys? That's why the disadvantages is that it can be misleading while comparing projects with different life. You cannot compare a 20-year project to a 10-year project. Correct. It has to be an apple to apple comparison. If you're doing a comparison of a different life cycle project, then you need to see that every year, how are you maximizing your returns? Clear, everyone? Any doubts still here? Now, guys, all of these advantages and disadvantages, because what happens is whenever you're doing any of this NPV or any calculation, there are a couple of marks for the commentary. That is a suggestion. In that suggestion, you need to ensure that you give what the project should be doing, and you also need to mention the advantages and disadvantages of a particular model. It is really critical to mention the advantages and disadvantages of a particular model because it gives a management an insight on the non-financial factor, because every time financial factor is not the only matrix that decides. You need to be aware of the non-financial matrix as well. Clear, everyone? Yes, no, confused?
Yes, sir.
Yes, sir.
Yeah.
Can you read this question? I'll give
Yes,
you
sir.
10 minutes. Sorry?
Sir, I have a doubt.
Yeah.
Sir, then how do we compare project of different life cycles?
That's what I showed you, right? You compare yearly returns. That means every year, what is the return you're making? Now, in project one, you're making every year 100. But in project two, you're making every year 75. What does this mean? This indicates for every 1 rupee you invest, you're getting 1 rupee back.
ROC.
But in project two, every 1 rupee you invest, you're getting only 75 paisa back. Correct? That means
Yes.
if I invest in project one for 10 years, and if I roll that money again for one more period, then I will end up making 2000 instead of 1500. Correct?
Yes, sir.
Understood now?
Yes, sir.
Now, guys, can you read this question, Allegro Technologies? This is a past exam question. Okay. This is not something that we have made up. This is something that has come up in an ACCA paper, which is asking us to calculate the NPV. Okay. Now, I don't want you to read the solution. I just want you to read it says assess whether the ATC company should undertake commercializing and innovation of the engine components or not. Clear, everyone? I'll give you 10 minutes. I don't want you to read the solution, but I only want you to read the question and try and understand what is going on in the question. Clear? Can you do that? Can you do that, guys? Everyone has access to the notes, guys.
No, sir.
Naomi, why don't you have an access till now? Are you
Sir.
stuck somewhere?
No, sir. I've received a mail that my notes have been dispatched. I received it yesterday.
Everyone else has received the notes?
Received.
We have
No,
online
sir.
course.
Mine is also on the way. Like it was dispatched.
Okay, no problem. I have presented my screen. Please read it from here. Okay. And once you are done reading from here, let me know. I will scroll up and down as and when it's needed. Okay.
Yes.
Just give me a sec. Let me just open to one of the questions. You guys read the question and let me know once you're done reading. And whenever you want me to scroll, I might wait for others also to read, but I'll give you 10 minutes, guys. Read the question very carefully. Okay. Now, you know what all information you need in a pro forma, correct? You know you need sales, you know you need cost, you need fixed cost, you need inflation, you need discount factor, you need investment, you need scrap, and you need working capital. When you're reading the question, please make sure you highlight those information. Please start, your time starts now. Please start reading the question and then we will solve it. I'll show you how do you solve an ACC question. Guys, let me know when you want me to scroll.
So please scroll.
Guys, everyone also done reading till here? The first two paragraphs?
Yes.
Yes.
Then I've scrolled. Guys, done reading? You want me to scroll down?
Yes, sir.
Guys, done reading, everyone?
Yes, sir.
Everyone else?
Yes, sir.
Okay. First thing I want you me to explain the scenario. Guys, whenever I talk about explaining me the scenario, what I mean is, what does the company do? What are they trying to go into? I just want to know the case study, like what is the situation. I don't want to know what is expected in the answer and all. I want to know what's going on in the company. Okay. Then we'll see what we need to find out. Can someone explain me what does it mean?
So there are three proposals. One, we can produce it ourselves. Second, we can give the rights to another company to produce for us. Then the third one is we can sell the rights to some
Okay.
company.
But what does the company currently do?
Yes.
Manufacturing motor vehicle parts.
Manufacturing
Motor vehicle parts.
motor vehicle parts. Okay.
But currently, they are going to produce an innovative energy saving engine component. Further, they have purchased patent for 2 million.
Okay.
At the same time, they are spending 5 million to develop prototypes for the uh, innovative engine component.
Okay.
Uh,
And what is the question asking us to assess? Whether we should
undertake
commercialize
the
the new engine or not commercialize, right?
yes, sir.
Okay. Now, guys, uh, okay, let me just pull up my screen. Um, hmm. Can you guys see my screen?
Yes, sir.
Okay. Now let me do one thing. Just give me a sec. But this particular question has a lot of information, okay? When I talk about having a lot of information, what I mean is that what I mean over here is when I talk about this question having a lot of information and all, there is one more part to this particular question which we'll be covering when we do options, okay? But right now we'll only focus on calculating the cash flows
NP.
for the company, okay? Can you see my Excel sheet in front of you?
Yes,
Yes.
sir. Yes, sir.
Okay. I want you guys to do this pro forma. Can you just put up this pro forma on your Excel as well? I'll give you 5 minutes because we'll solve it together. We'll see. See, this is nothing, but this is the same pro forma you remember that we discussed,
Yes, sir.
right? In this thing, I've just added one more line. I've added as other cost. Okay. Why I always add as a line as other cost is because what happens is that sometime examiner gives you an additional cost over and above fixed and variable. So then it should not happen that our pro forma changes, calculation changes and all, right? See, we can leave it blank. We will not lose any marks for that. So it is always better to have a space with us. Okay? Clear, everyone?
Yes, sir.
Can you just put up this pro forma and then we'll just see how with fill in the blanks we can get to a 20 marker question, guys. This is a 20 marker question that has come in AFM paper. Okay? I'll give you 5 minutes. Can you just pull up this? Can you just put up the pro forma in your Excel?
Yes, sir.
Let me know once you are done. Then I'll start. Then we'll move on to solving it.
Yes, sir. Done.
Everyone else also done?
Yes, sir.
Guys, can you please respond so I know whether I should do it or not do it?
Yes, sir.
Yes, sir.
Yeah.
Okay. Now, first we need to fill our sales. Correct?
Yes, sir.
Okay. Now, so sales is my working note 3. right? Sales is my working note 3, right? See, do you know why am I doing a separate working note for this?
Because we need to adjust the inflation.
Correct. See, guys, sales revenue directly is not given to me. Correct. If it is not directly given to me, then what happens is I'll have to do a lot of multiplications, number of units, multiply by sales price, multiply by the inflation and all. Okay. So always have your presentation clear. And this does not apply to only the exams when you go in the real life also. Okay. If you create too much chaos in the main report, people get lost in the report. Correct? You need to be clear in your presentation because if you remember, you have 10 marks for professional marks also in ACCA, correct?
Yes,
In P level paper. So you need to be clear in your presentation as well to ensure that you do things correctly. What is the question asking us to do on sales?
sales would be uh, increased by sales price increased by 8% per year. So based on that,
Sorry?
so sales price is increased by 8% per year.
Hmm.
So based on that, we have to calculate our sales revenue for the 5 years.
Okay. What is the sales unit in first year,
7,500,
second year?
20,000.
Okay. Are you telling me the absolute numbers or are you telling me the round off numbers? See, guys, in
Those
ACCA,
absolute numbers.
absolute numbers. Guys, in ACCA, you can work it out in thousands, you can work it out in millions, you can work it out in any number you want, okay? Like if you want to put 7.5, 20 and everything is also fine. But this particular question, I would go with the round number since it's the very first question that we are doing. What is the sales in the third year?
Sorry, 50,000,
50?
50,000,
Okay.
60,000 and 95,000 for the 5th year.
So these are units.
Yeah, these are units,
Yeah,
right? Sales units.
sales unit.
I'm just writing sales unit right now. To calculate the sales revenue, I need to multiply the sales unit with sales price, right?
Yes, sir.
Right?
Yes, sir.
Everyone with me till here? Ishita, Harshita, Daksh, everyone?
So can you please zoom?
Yeah. Better now?
So, yes, sir.
Okay. What is the sales price?
For the 1st year, it would be 1,000, sir.
It is 1000. So 7500 units multiplied by 1000 is how much?
7.5 million.
7.5 million, correct? Or 75 lakhs, we can say. What is the sales price in next year?
It would be increased by 8%. So
It is
1080.
increased by 8%, but from what?
1,000.
1,000.
Year one.
Year
How do
one
I
sales
calculate inflation? That is year one selling price multiply by 1 plus how much
8%.
percentage?
8%.
8%. Year 3, how will I calculate inflation? Again, 1000 into 1 plus with 1 plus 8 will I do or will I take year 2 selling price?
Year two selling.
By year 2 selling price?
Because they have said that it will increase by 8% per year.
Per year.
Correct. That means your baseline is every year your previous year's sales price is gonna increase by that number. Clear everyone?
Yes, sir.
Yes, no?
Yes,
Kita
sir.
till here?
Yes.
Okay. So we got our sales price. Can you calculate the sales price on your laptop as well, please? Then I will move on to the next part. See, for you guys also to do it simultaneously, it is very important because right now you'll understand. But when you solve it by yourself, there might be a case that you might get a slight different answer. So we can discuss that in class if you're going wrong in calculation. Everyone calculate the sales price and please confirm me once it's done. And guys, I will also be sharing this Excel sheet with you. Everything that you solve in class, I will also ensure that you get this Excel sheet so that you can practice it. Now, guys, the very best thing about the Excel exam is you just need to put out a pro forma once. Like if you have to do a similar NPV question, you just need to copy paste the pro forma and keep on changing the numbers. That way you can practice maximum questions in the less amount of time. Yet, clear everyone? Guys, with me till here?
Yes, sir.
Yes, sir.
Okay. Has everyone calculated the sales?
Sir. Sir.
Guys, everyone calculated sales price?
Yes, sir.
Okay.
Yes, sir.
So what I've done is
Sir.
I have populated the sales price in my main pro forma. That is year 1, year 2, year 3, and year 4. What is the next line we have in our pro forma?
Variable cost.
Variable cost. Variable cost I am doing working for. Do you know why?
Increase by
This
Again,
also
inflation
affected
is
by
there,
inflation.
right? How is variable cost calculated?
So sales units into variable cost per unit will get a variable cost, total variable cost.
How much?
Sir, from sales unit, we will multiply with variable cost per unit, then we will get a total variable cost.
Correct. So number of units multiplied by the cost. So number of units I will not discuss because we have already put in over here. What is the cost in the very first year?
400.
What is in the next year? How much is it
Four-
increasing by?
5%.
5%. So year 1 increasing by 5%, year 2, year 3 increasing by 5% on year 2, right?
Yes, sir.
Clear?
Yes, sir.
Can you calculate the variable cost and plot it in your main pro forma? See guys, once I have a direction that where I need to go, it becomes easier to walk on that path. But if you have to figure out how to calculate every time, you might get lost in numbers, right? So that's why any question that we'll be solving, we'll try to minimize it with a pro forma, a standard pro forma, so that if you get a question, the first thing in your mind should be fill in the blanks. Please calculate this.
Yes, sir. Done.
Done, everyone?
Yes, sir.
Clear with me till here? Yes, no?
Yes, sir.
Yes, sir.
Yes, sir. Done.
What is the next expense? Is there any other expenses? Because see, I need to calculate the net operating cash flow. So what is there any other expenses mentioned?
Yes, sir. Fixed cost.
Hmm?
Fixed cost.
Fixed cost. What is the question telling on fixed cost?
1,500.
Same as variable cost. It also increased by 5%. The fixed cost for the first year is 1.5 million.
Fixed cost for the first year is how much?
1.5 million.
1.5.
5 million.
So it's not there in line. So should I put a negative sign or a positive sign?
Negative sign.
Negative.
Guys, be careful, okay? Your sign segmentation has to be correct. 1.5 million in first year. What is it in second year?
1.57
by 5%.
Sorry?
1.575 million because it increased by 5%.
Every year is it increasing by 5%?
Yes, sir.
Yes,
Or is
sir.
it stopping somewhere?
Every
Fifth
year
year.
it will increase.
Okay. So I've increased my fixed cost.
Yes, sir.
Clear, everyone?
Yes, sir.
Is there any other cost?
Training and development.
What is the question telling you on training and development cost, guys?
120% of variable cost for first year.
120% of variable cost. In second year,
40% of
40%. Third year,
10%.
fourth,
10.
and then fifth. fifth is again 10, right? After third year, it's standard down to 10%. Do you know the logic why the variable cost, why the training and development cost is coming down on an year-on-year basis? Do you know the logic for that?
Maybe, sir. Only the new employees are require training.
Two things. First, only the new employees are required, and your existing employees have reached their learning curve. Correct? You have taught them everything, right? So they are completely trained employees for you at this point in time. When you start the project, you have to spend heavy on training and development because your staff is not up to the mark or they are not trained to that level. Got it?
Sir, I have a doubt.
Yeah.
Sir, can you please show me the calculation for training and development cost also?
Variable cost is how much?
So 30 lakhs
Into
120% for the first year.
second year, what is the variable cost?
8. Okay, sir, got it. 84 lakh.
Got it?
Yes, sir.
The question says, my training and development cost is an X percentage of variable cost, correct?
Yes, sir.
Where was it mentioned? Yeah, this one. Can you see this line?
Yes, sir.
First year, second year is given. And from third year onwards, we know it is fixed at a 10%. Clear?
Yes, sir.
Any questions still here?
Got it, sir.
Okay. Can you solve till operating cash flow, please? Can you do it in your calculation also? Then I will move forward because before we do tax, I want you guys to calculate till this row. Everyone, please do it. Guys, you guys are solving along with me simultaneously, right?
Yes, sir.
Right? Because what happens sometimes you might not get the same answer, right? So you need to be on track on this.
Sir, done.
Everyone else also done?
Yes, sir.
Yes.
Okay. What is the next thing?
Taxation.
What is the question talking about taxation, guys?
10% on 10% is straight line basis.
No. What is it? I'm talking tax. I'm not asking depreciation. What is the tax rate? Whether it is paid in arrears, whether it is paid in same years. What is the question talking on that? See, depreciation is an element to tax.
Okay.
Okay. But we need to first focus on what is the tax rule says. What is the percentage to be paid? Which year is to be paid? Clear?
Mm.
Yes,
Okay.
sir.
What is the question telling? What is the tax rate?
Okay.
What is the tax rate, guys? Come on, it's given in the question, right? Is the question mentioning somewhere? Guys, what is the tax rate? Can you guys have read the question, right? What is the tax percentage? Naomi,
don't think
Shashidran,
it's
Meet, what
given.
is the tax percentage?
I don't think it's given.
Sorry,
I don't
20%.
think so.
is it given or is it not given?
Not given.
Not given.
Not given.
I think they have just put an extract of the question. Let me show it to you. You remember I told you this is a past exam paper?
Yes.
This is an exam paper. This is a full question that we have. We have 13 marks. for this part, what we are solving right now. Correct? Additional data is not given because additional data relates to options chapter, but only one line is relevant for us, which is nothing but this other data. Okay? What is the tax rate over here given to us as?
20%.
20%. Okay? So we know the tax rate is 20%. Is it to be paid in advance, arrears, or in the same year? If nothing is mentioned, it is assumed to be the same year. Okay? With me, everyone till here?
Yes, sir.
Yes, sir.
Now let's go on to the solution. How will I start? I will start in my operating profits. Correct?
Yes, sir.
But these are my cash profits. I get a depreciation benefit, right, guys? Yes or no?
Yes, sir.
What is the depreciation available on? On my what? Investment?
Initial investment.
What is my initial investment?
20 million.
Machinery,
120 million.
How much?
120 million, sir.
20 million.
120 million. Okay. And what is my depreciation rate?
10% WDV.
10%.
10% of. So that is nothing but 1.2 million.
Yes, sir.
So first year I'm putting 1.2 million. Second year I'm putting 1.2 million. Third year I'm putting 1.2 million. Fourth year I'm putting 1.2 million. Now guys, understand one thing. In the last year, okay, what do you do with that asset?
Sell. Scrap.
You scrap it off, correct? When you scrap it off, as per income tax, there are chances that you'll either make a profit or you'll make a loss, correct?
Yes, sir.
So you will compare it with the book value. Do you know what do you mean by a book value of an asset?
Carrying amount.
Carrying amount. That is the amount that is there in your balance sheet after taking into the account the depreciation. Understood?
Yes, sir.
Any questions still here?
Mm.
Okay. Now, so in the last year, what I'll do is, guys, so typically you can directly do the depreciation calculation over here. But for explanation, I try to do it separately. Okay. My initial investment is how much?
120.
120 million.
Per year depreciation is how much?
1.2.
1.2.
So 4 years will be how much? 1.2
480.
multiplied by 4.
480.
Okay. What do you mean by WDV?
Written down value.
Written down value in your books. That is nothing but the carrying value. How do you calculate a carrying value? Your investment less the
Minus accumulated
depreciation.
depreciation.
Accumulated depreciation, correct?
Yes, sir.
So what is the carrying value in my book?
7.2.
7,20,000.
What is the scrap value? How much am I selling it for?
40 million.
How
40
much?
million.
40 million.
40 million.
Did I make a profit or did I make a loss? When I sold my asset, did I make a profit or did I make a loss?
Loss.
Loss.
My book value is 7.2, but I'm only, 72 million, but I'm only getting 40 million. Correct?
Yes, sir.
That means 32 million is a loss. So when I make a loss, do I pay tax or do I save tax?
Save tax.
Save
I
tax.
save tax. This is something we call it as a balancing allowance, guys. Okay?
Sir,
Yes, Hariyan?
sir, could you please repeat?
Okay. What is the value of asset that is there with you?
7.2.
72 million or
Yes, sir.
7.2 million? How? 72 million it is. Okay.
Yes, sir.
When you're going to sell that in the market, how much value are you getting?
For 40 million.
40 million. That means something is worth 72 million to you, but you are only getting 40 million. So did you incur a profit or a loss?
Loss.
Loss. When I incur a loss on a transaction, can I reduce my profit to that extent for the payment of tax?
Yes, sir.
Because if I'm making 100 rupees in my operating activities and I have 50 rupees loss in depreciation, I only need to pay 50 rupees as tax, right?
Yes, sir.
Clear?
Yes,
Yes.
sir.
Any questions still here?
Sir, and the tax allowable depreciation is, isn't it 1.6 million?
Sorry?
Instead of 1.2, it should be 1.6, right? You should deduct the scrap value while calculating the depreciation.
No, you don't do it in the cash flow method. Because see, the formula that you are telling Hariharan, you're talking about a straight line method and accounting formula. That is investment less scrap divided by number of years. Correct?
Yes, sir. Yes, sir.
Now, we say it's a straight line, but technically speaking, it's a WDV method that we use. Because the question is specifically telling that every year your asset will depreciate by 10% only. Understood?
Yes, sir.
If the question says otherwise, it's a straight line basis or something, that's when you use, because depreciation has two methods, straight line and WDV. Correct?
Yes, sir.
WDV, you deduct an X percentage every year and then you compare it with the scrap value or when you're selling it.
Sir, but for tax purpose, we are using SLM, right?
Sorry?
For tax purpose, calculation of TADP, we are using SLM.
Yes. In this
But,
question, yes.
so
But
we should deduct scrap value, right? According to
no,
you.
no, you'll not deduct the scrap value because your formula is the scrap value formula is to be used when uh you are using when the percentage is not given to you and you want to calculate your yearly depreciation. Typically, you are trying to make asset value 0 in 5 years. Understood? That's when you use that formula. Over here, irrespective you do either of the ways, this is a realistic approach. We are over here not looking at accounting treatment, we are looking at tax treatments over here. Got it?
And no, sir, could you please explain?
Okay.
Sir, also why we're taking 4 years instead of 5?
Sorry.
Why are we considering it only for 4 years? We have 5 years, right?
Okay. In the last year, when you sell the asset, first I'll answer your question, Hari, and then I'll come to you. In the last year, when you sell your asset, will you
Okay.
have a depreciation or will you compare it with your book value of the fourth year? You're selling the asset in the fifth year, right?
Yes.
Okay. But to answer your question, Divesh, even if you take this for 5 years and you put this over here, okay, and you multiply this by 5, your answer will not change. Your answer will still be 32. Got it?
Okay.
That answer does not changes with that because the methodology is such. It's just the presentation impact. You want to present it this way, we are good. But technically, what happens is in the last year, since we are selling it, we compare directly whether we are making a profit or a loss.
Yeah.
If you depreciate the asset in the
Mhm.
fifth year, your WDV comes down and your difference between the balancing allowance and charge comes down. Clear?
Okay.
Okay. Now, Hariran, coming to your question, you are talking about a straight line formula that is initial investment minus scrap value divided by number of years. Okay.
Yes, sir.
That's the accounting formula. In this question, you have been given a specific scenario that every year you can depreciate the asset only by 10%.
Yes,
You
sir.
know, sorry?
So we have to depreciate by WDV and then comparing it with the
Correct,
scrap value.
correct,
But for the tax purpose, we are using SLM.
correct.
So we should use scrap value for tax
No,
purpose.
no,
We
no,
should.
no, no. You are confusing it with the real life scenario. Even in income tax rules, in real life, if the company is using SLM, income tax rules in India allows only WDV method. It does not allow an SLM method. Do you know that?
No, sir.
Right? So technically, it's telling you, see, this is the question where a scenario has been drafted. Right? In real
Yes.
life, when you do it, you'll have to do as per the income tax rules. Over here, the rule is telling that for the first 3-4 years, you can get a maximum benefit of only 1.2 million, or let's say 12 million. If income tax says I will not give you more than benefit of 12 million, can you use any of the formula and get that benefit?
No, sir.
Tax is a rule based game. If someone is telling you something, then that rule has to apply. Tax may we can't do anything. We can't apply that logic, because if the rule says maximum 12 million, even if my depreciation value is coming to 20 million, I can maximum deduct is 12 million. Correct?
Okay.
Right? So in tax, you will have to go with what the question says, and this is a scenario. Try to understand these are scenario based question where the different kinds of adjustment you will learn. So over here, the learning is not that we need to use straight line or we need to W. The learning is whatever the rule says for the tax, we have to follow the tax rules. Understood?
Yes, sir. So for taxation, we do not include scrap value in the TADP.
No. Unless and until question specifically tells you.
Okay.
Okay. There will be times where we will see adjustment where the question is specifically telling you to do something. Because tax is a rule. If the question tells me tax, this is how you should calculate tax, I'll have to calculate using their method. While companies also prepare their books of accounts, they do depreciation in their books of account as per them. But when they prepare their tax P&L, they do the calculation as per whatever the income tax says. Understood?
Yes, sir.
Any questions?
No, sir.
Now, that means I've calculated my taxable profit, right? That is revenue, operating cash flows less the depreciation. So if you see in the first 2 years, I have a positive thing. What does that mean? That means I will get a tax refund. Correct? Yes or no?
Yes.
Right?
Yes,
Now,
sir.
why am I telling tax refund? Because see, guys, this is an existing company. Correct? They are going into new business. That means if they incur any loss, their existing profits can come down, and to that extent, they will have to pay a less amount of tax. Correct? Now, there are some questions will come across a situation, since this is a rule based thing, where it says if there are any losses that can be carry forward. If the question says that, then we will not have any income in that, but we can set it off against the future profits. Correct? So
Yes.
tax, that's why I told tax calculation always do it separately, because it's a rule based and they can put any rule they want as an assumption. Clear?
Yes, sir.
Clear, everyone?
Sir, can you explain why do we deduct balancing allowance for charge?
You made a loss, right?
Yes, sir. And
If
yeah,
you make a loss, income tax allows you to reduce your profit to that extent,
yes.
right? Because when it's a profit, but when we are making profit, they take money from us. So when we make a loss, technically they should not ask us money, right?
Okay, sir.
Clear?
Yes, sir.
Any doubts still here? Any doubts, guys?
Yes, sir.
Okay. Everyone clear on the tax calculation?
Yeah.
Sir.
I'll give you 2 minutes. Can you please solve the tax calculation? Please solve the tax calculation in your Excel, and then we'll move forward. Guys, done solving tax? Yes, no, can you please respond?
Yes, sir.
Okay. So we have plotted tax over here. Then let's come to working capital. What does the question say on working capital?
20% of first year sales revenue.
Okay. So
And then
my sales revenue is this. In working three, I'm taking 20%. See, guys,
so on
working capital requirement is something different, and incremental working capital is that goes into a pro forma. Second year, it is how much?
it is increase every $1 increase in sales revenue, it will require 10% of working
Okay.
capital.
That means year two revenue minus year one revenue.
Yes.
That is an increment.
Yes, sir.
On that, I need how much?
10%.
10%.
10%. Have I done that?
Yes, sir.
Okay. Year three, again same. Year three minus year two into 10%. Year four minus year three into 10%. Clear?
Yes, sir.
Any questions still here? Now, year one working capital I need in which year?
Year 0.
Year zero. Year two I'll need in which year?
Year 1.
Now, understand, we have already calculated the incremental value over here, na?
Yes, sir.
So that means I don't need to do year one plus reinvestment this, because this we have already calculating incremental, because we already did revenue year two minus year one revenue, and we are only calculating incremental over here. But I've just changed the sign segmentation and plotting over here. Clear? So year two in year one, year three in year two, year four in year three. And in the last year, what will happen, guys?
We save it back.
All your working capital will come back. Clear, everyone?
Yes, sir.
Any questions? Any question, guys?
No, sir.
Okay. So
Sir,
yes.
so the working capital invested in the start of the year will come at the end of the year. So it will be used for year two. So why we are subtracting 10,000 in year one then?
We are not subtracting, we are investing additional.
Yes, sir. Oh, this is okay,
Right? We are
sir.
investing additional 14 because my revenue is doubling, right?
Yes, sir.
Year one, I have 75 lakh, then I have 2.16 crores. So if my revenue goes up, my working capital will also go up, right? It's not a
Okay.
subtraction, it's a negative because I'm investing right now. In the last year, when I get it back, it's a positive. Clear?
Yes, sir.
Right? Okay. Then we don't have anything technical. What is my initial investment, guys?
120 million.
Positive, negative value?
Negative.
Negative.
Because it's an outflow, correct?
Yes, sir.
Sign segmentation has to be based on the logic, whether it's an inflow to the cash statement or a bank statement or it's a positive. What is the scrap value?
40 million.
Positive, negative? Okay. Discount factor, guys, assume to be 12%. When we do the cost of capital chapter, which is the next chapter once we finish all of this, you'll know why I'm taking 12%. Okay. But for now, take at 12%. Year one discount factor will be how much? Year one discount factor is how much? Sorry, year zero,
One, sir.
year zero. My bad. Year zero.
One, sir.
Now, let's go to our annuity tables. Now, there is no present value table. Okay, it's simple.
Say ACCA paper. We don't have it here. Second link.
Okay.
Page 9.
We will refer to the present value or we'll refer to annuity.
Present value.
Why? Because my cash flows are not consistent. Correct? So at 12%, what is the discount factor for year one? We have this table, right? For 12%, this one.
0.893.
Point
893.
0.893. What is for year two?
0.797.
Then
0.712.
Then
0.636.
Then
0.567.
point.
567.
Okay. Then my cash flows multiplied by discount factor will give me the present value. Yes or no?
Yes, sir.
And the total of everything that is from year 0 to year 5 is nothing but my
NPV.
NPV. So is my NPV positive or negative?
Negative.
That means should I take the project or not take the project?
No.
No. Now guys, you have to give a comment also because comment carries 1 mark. If you see, we never give decision. We just give our opinion. Correct? Right or no?
Yes, sir.
Whenever we give opinion, what do we say? Okay, this is my opinion. You decide whether you want to go ahead or not go ahead. Correct? That's what you mean by an opinion. Guys with me till here?
Yes, sir.
Okay. So what am I telling? This is a standard that you can write for any NPV question. If the NPV is positive, the management should go ahead. If the NPV is negative, they should not go ahead. However, it depends on the risk appetite. The reason, guys, I say it depends on the risk appetite is because what happens, let's say in retail business, sometime company opens a store which is a loss making, but the location of that store is very strategically important, maybe for marketing or maybe for brand visibility and all. Correct? Sometimes you take a loss making project just to ensure that you're visible in the market and you're spending. Like initially, when a new startup comes, they give discounts, correct, from their pocket and they make losses. Why? Because that's a strategy. If the company decides that if it's strategically important, then it has to be in that manner. So that's why we put in a standard answer that if the NPV is positive, we should go ahead. If the NPV is negative, we should not go ahead. However, depends on the risk appetite. Clear?
Okay.
Clear, everyone?
Yes, sir.
Can you finish the solution for yourself and let me know if you have any doubts? I'll give you 2 minutes to go through the question. The solution, ask me any doubts if you have over here.
Sir, can you explain the working capital, how you got 130? Hello?
Yeah, I'm just scrolling there.
How did you start with that 14?
I'm just coming. Okay. What does the working capital say? For every $1 increase in the sales revenue, I need how much?
10%.
So how do I calculate how many dollars has it increased by? I'll have to do year 2 revenue minus year 1 revenue,
Yes.
right?
Right.
So year 2 minus year 1 revenue is how much? 1 point. How much is it? 14.1 million. Correct?
Right. Right.
Of that, how much do I need?
10%.
10%. Understood?
Okay.
Similarly, when you go to year 3,
Hmm.
year 3 minus year 2 is an incremental revenue. On that incremental revenue, you need additional 10%. Understood?
Yes.
Clear, everyone? Any question, guys?
No, sir, clear. And then what about the 5th year?
5th year is nothing but a total of everything, right? Whatever you invested till date, you'll get everything back now when you shut down the project. Because working capital is not an income or expense. We are just doing it because of the time value loss over the year, correct?
Okay.
Because I'm investing 15 million at the start of the year, I'm getting back in 5 years. That means I'm losing 4 years ka time value, na?
Yes. Okay, sir. Okay.
Understood?
Yes, sir.
Any questions?
No, sir, that's
Guys, anyone else, any other questions on this? Yes, no, confused, lost. Are you guys clear on this?
So when are you going to share this
I'll
Excel?
share it today by end of the day. I think we have a WhatsApp group also created, right?
Yes, sir.
Yes, sir.
Yeah?
yes, sir.
I'll put it on the WhatsApp group. No, don't worry.
But I'm not on that group.
Can you please ask the student coordinator to add it?
Okay.
Can just speak to them, and if your issue still doesn't get resolved, just let me know. I will speak to them and get it sorted, because before next class, make sure you get the notes, and probably you might not get it tomorrow, but I'm talking before the coming week class. Yeah. But just get yourself added to the WhatsApp group so that you are staying updated, and because it will be easier to share the Excel on the WhatsApp group. There's anyone who's not there, make sure you have added to the group, okay? Everyone clear on the solution? Anyone has any doubts, any of the approach, concept, any questions?
Sir, do we require scientific calculator?
No.
Okay, sir.
In fact, since it's an online based paper, you are doing it on Excel. You won't even need a calculator, because Excel helps, the formula itself helps us calculate things.
Okay, sir. Thank you.
Yeah. Anyone has any other question, guys? Divesh, Durga,
No, sir.
Laksh. Okay. Guys, with this, we are done for the day. Uh, Initially, I'll not stretch much on these things, because, and guys, understand this is a past exam paper. Any solution that we are doing will be solving only ACCA standard question, even as an example, so that you guys get used to those kind of stuff and solving. Okay. Make sure you have your proforma right. NPV is all about having your proforma. Even if you are lost somewhere in the question, if you have your proforma, you need to know, you need to fill in that blocks. Or in fact, it might remind you to say, okay, am I missing on cost? Have I missed any other cost to take, right? If you see that, okay, other cost, let me check if there is something else, right? So that's why we rely on the proforma over here. That's a good way to score easy marks. Everyone clear till here?
Yes, sir.
Okay, guys, thank you. With this,
Sir,
we are done for the day. Yes.
so with regards to the Excel calculation, should we learn some complex formulas or?
No, 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 no. No need of learning complex formula. Your basic formulas are more than enough. And if you see, even when I solve, I don't use any complex formula. I only use addition, subtraction, multiplication, and division. Keep it simple. You
Okay.
don't need to be an advanced or pro at an Excel, guys. But you just need to know your basic addition, subtraction, multiplication, and division formulas. And there's a board mass rule, brackets first and all of those things, where the equation that you do is to solve in class. You need to ensure that you put your brackets correct. So that's one thing that you need to learn. Okay.
Yes.
Okay, guys. Thank you.
Oh. Sir,
Yeah.
sir, will we be able to cover the syllabus as per the schedule?
Yeah, we will. Why?
Okay, sir. So because the SBR faculty last September extended the class by 1 hour because weren't able to complete the syllabus. The last month he extended the class from 8:30 to 1:30. That's
Don't
why I
worry.
asked.
SBL is a different paper, Hari.
SBR, sir.
SBR? Okay. No worries. We'll be easily, comfortably covering our portion along with solving and revision as well. Don't worry on that. And within the same time and within the same time frame that we are.
Okay, sir.
Okay.
Okay, sir. Thank you.
Okay. Thank you.
Sir,
Yep.
sir, apart from AFM, I want to get a job in this management consultancy. So, is there any soft skills should I need to start now itself?
See, soft skills may what you need to do is you need to know your Excel.
Okay,
Okay. Concept, you will learn it in class,
okay,
but learn Excel.
okay,
Because once you learn Excel, now your presentation and your analysis skill will improve.
okay,
Because what happens is we know what we want to analyze, but we don't have the adequate amount of Excel skills. Or probably we have an adequate amount of Excel skills, but we do it very basically, which very time consuming.
Okay.
Once you learn Excel, management consultancy and all is about building dynamic models.
Okay.
To build models, you need to know the Excel formula. So get your hands on Excel.
Okay, sir.
Probably not the basic one. I'm talking about the advanced one.
Advanced, yeah.
Yeah. It will help you a really lot.
Okay.
Okay.
Okay, sir. Thank you.
Thank you, guys.